सर स्टार्ट करिए।
Yeah, thank you. Hello. Yeah, I welcome all the participants to this to the third day of the National Conference on the Corporate Laws. It is a very relevant national conference, I would say, and especially when the corporate laws are so important, because the backbone of the economy, I would say, are the corporates. And whenever we are doing the audits and all these things, corporate law becomes very, very important. If you are not aware of the basic provisions of the Companies Act, then the things become very difficult for us. And this conference has been designed with keeping in all the aspects of the Companies Act. And today we are having the learned faculty with us, Anand Bathiya ji. We are also having my council colleague, Abhijit Kelkar ji, and the coordinator for this program for today's session, Sanjay Nikam ji. Now I request my council colleague and dear friend, Abhijit Kelkar ji, to please introduce our today's learned faculty, Anand Bathiya ji. Over to you, Abhijit bhai.
Thank you, Vikas bhai, for this opportunity. I also recognize the presence of my very dear friend Sanjay Nikam from Navi Mumbai. And here I am introducing the wonderful personality who is today's speaker, CA Anand Bathiya ji. He is a practicing chartered accountant with experience of working with world-leading accounting and professional consulting firms. Friends, he is a fellow member of ICAI and has also completed the final examination of company secretary course. He is a Bachelor of Commerce and a Bachelor at Law with postgraduate diplomas in Securities Law from Government Law College and in Information System Audit from ICAI. Friends, as a partner and practice head with Bathiya and Associates LLP, CA Anand is engaged in advising businesses in negotiating, structuring, performing due diligence, and executing domestic as well as international mergers and acquisitions, and having advised more than 200 mergers and acquisition till date, that is over past 15 years, which includes few of India's largest merger and acquisition transaction in recent times. Friends, C. Anand has enabled businesses to raise equity resources through public equity and private equity, including capital market initiatives of IPOs, QIPs, right issues, open offers, international listing, etc. C. Anand also specializes in advising private equity funds and families offices in formation, fund documentation, diligence, and investment transaction executions. C. Anand is a managing committee member of Bombay Chartered Accountants Association and a co-opted member of a group of Valuation Standard Board for drafting valuation standards to be made applicable in India. He also represents as independent director and audit committee chair on board of listed companies. And friends, apart from these all achievements, he loves playing cricket and chess in his leisure time. So please welcome this towering personality and academician par excellence, C. Anand sir, to this program. Anand sir, on behalf of WRC, I heartily welcome you. Over to you, Vikas bhai.
Thank you, Abhijit bhai. So today we would be having a sheer pleasure of listening to Anand Bathiya ji, and who could have been a better faculty than him to tell us on the opportunities that are there for the chartered accountants under the corporate laws. And since he himself has explored many of these opportunities and is having great experience on all these subjects, so I request Anand ji to please enrich our members with the various opportunities that are available for us. Thank you, Anand ji. Welcome to you.
Thank you. Thank you, Vikas ji, for the kind words, and also Abhijit ji for the kind introduction. Happy and delighted to be here at this national conference on corporate laws. And first of all, my compliments to the entire organizing team for structuring and curating this program in a very efficient manner. I could see technical topics which are very specific on subjects involving corporate law and which are widely discussed topics. and also this sprinkle of non-technical topic that we have right now in terms of opportunities under corporate law is also something that I would like to spend the next 30 minutes on. Friends, the corporate law landscape, before we get into the specific, as most of us practicing chartered accountants or maybe in our employment roles, as CAs, we predominantly operate in four silos or four verticals. The first one is maybe the direct tax, which is the bread and butter for quite a few of chartered accountants that we are. Second is maybe the indirect tax, which is the GST and related areas. Third can be the accounting and the assurance, which is the audit, internal audit, risk advisory. And fourth is maybe the segment of corporate laws. Now, this fourth segment of corporate laws is not something that is an exclusive domain of chartered accountants. We would see over here company secretaries, lawyers, in some of the areas, cost accountants. So the other three domains, which are by and large chartered accountant dominated exclusive domains, corporate law requires slightly different skill sets and a little bit integrated multidisciplinary approach towards making a difference in that particular vertical. Personally, I think that there are challenges in the direct tax, indirect tax, and the assurance domain, which are particularly not there or at least less in the corporate law space. Like if you see the tax sort of silo or vertical, it is becoming more and more compliance oriented, and we are getting affected by technology in terms of opportunities to contribute towards nation building. Even in the indirect tax, we are seeing technology taking a lead. Some of the areas of GST audits, etc., also on a back burner. Assurance, which is the third platform, I personally see the risk and rewards not matching in the assurance domain. And also personally, for me, it's more of a post-mortem where things have actually happened and then you are going and doing audit, or it's more of a fault finding exercise. Corporate law, which is the fourth pillar, essentially is more proactive. You are in the front seat, you are going for compliances, you are incorporating companies, setting up businesses, merger acquisitions, raising resources, and that's very much frontline. And to some extent, not quite affected by technology or maybe some of the other risks that other platforms carry. But yes, it's a domain not exclusive to CA, and hence we have to upskill and reskill ourselves a bit in order to do justice to the landscape that corporate laws is. Friends, over the past decade or so, the landscape of corporate law has been an emerging landscape. And if I am able to dissect these opportunities into 6 compartments, I would think the first sort of opportunity to contribute as chartered accountants came through the Companies Act 2013. Remember, Companies Act is just one part of corporate laws. When we talk about corporate laws, it's a slightly larger domain than just the Companies Act as a specific subpart of that domain. Now, Companies Act brought about a lot of changes, and quite a few of them are opportunities. Quite a few of them are also responsibilities that we as chartered accountants now undertake when we are performing that role. The second domain where there are quite a few opportunities which are emerging and also there right now is the security laws domain, which is predominantly dealing with publicly listed entities. SEBI is the regulator, and quite a few listed entities are governed by securities law, and plethora of opportunities there for chartered accountants. The third domain at a very high level, if I can capture, is the change that came on account of the introduction of registered valuer. Now, the registered valuer is also operating in the domain of corporate law. Essentially, it's a part of the Companies Act Section 247, and IBBI, which is the Insolvency and Bankruptcy Board of India, is the current regulator for registered valuer. And opportunities have been unlocked through the registered valuer change that came in recently. Fourth, the insolvency and bankruptcy, or as we commonly know, the IBC. This clearly is the watershed moment in India's corporate landscape. And to my mind, if we keep the publicized changes that this government has brought in terms of demonetization, GST, etc., one change of this government that stands out is introduction of IBC. 5 years before, we couldn't have thought that some of these companies, which are home names of the world, will no longer be existent. And we'll have a solution that in India, companies can be taken away from the hands of promoters. But IBC has done that, and it gives a lot of opportunities for chartered accountants to contribute. The fifth is representation. Now, all across corporate law, chartered accountants were never in the forefront for representation. When I say representation, it basically means advocacy. It means making sure that you are able to go to the then High Court, then CLP, and now NCLT. But a big change has now come because of tribunalization of the Companies Act jurisprudence, because of which chartered accountants are now at par with some of the legal professionals to go and appear before the NCLT and also the appellate tribunal. And there are significant opportunities here which have opened up because of NCLT. The sixth, and to my mind, a future looking and a very near opportunity is ESG, or environmental, social, and governance. We saw a few years before CSR, or corporate social responsibility, came into play, which is the S part. But now we are seeing ESG being adopted in a big way. And the recent introduction that SEBI had in terms of top 1,000 companies having to disclose business reporting, sustainability reporting is something that also has an opportunity for chartered accountants to contribute towards. So these six subsets, to my mind, cover the emerging landscape of corporate law. Apart from that, we have FEMA, stamp duty, competition law, which are there as a part of corporate law. But these are the key sort of opportunities that I see, or how I could bifurcate them into. And we will go one by one into each of them and see which are the key changes or key opportunities that are there for chartered accountants. The first one is the Companies Act. Now, friends, I have been a student of Companies Act because I have also done my company secretaryship course. And when we were doing the intermediate and the final examination sometime in early 2000s, there was a fear that whatever we are studying in the Companies Act 1956 is just not going to be relevant. Because by the time we qualify, we may have a new Companies Act, and it would be again starting from scratch in terms of learning the things, the concept, the sections, etc. So I have been tracking Companies Act since it was the company's concept paper done by the J.J. Irani committee in 2002. From 2002 until it became an act in 2013, in that 11 years, what was proposed under the concept paper and what actually culminated into the act is a significant distance. What happened in these 10 years is that India, or as a nation, we had four major corporate anomalies or frauds that were there, and each one of them had its impact in terms of how the law evolved. So the 2002 Companies Act concept paper was a very proactive discussion paper, and it had lot many things which we could do differently than our old Companies Act. But when it came in its final shape in 2013, that proactive nature became more of a reactive nature, thanks to these four major scams that cast its shadow on the evolution of Companies Act. The first, as we all know, was just emerging around 2003-4, the Ketan Parikh and the related concerns of intercorporate borrowings, loans, stock market, etc. And we see Section 185, Section 186, the restriction in terms of giving loans, intercorporate, etc. All were thanks to that particular issue. We had the second concern coming from the Sahara issue, where essentially small amount of debentures were raised, OFCDs were raised, and they were deployed into different assets, which ultimately did not yield the desired return. And we see tightening around acceptance of deposit, raising of money from public, and all those things are thanks to maybe the Sahara anomaly that we had. The third was the 2G thing, which also happened somewhere about 2009-10, and we see mandatory consolidation coming in. We see consolidation of joint ventures associates coming in. We see mandatory cash flow coming in. We see MCA having powers to control overseas subsidiaries of Indian companies. All of that thanks to the 2G anomaly that happened. The fourth, and what stands out, was the Satyam issue, which also sort of came in 2009-10. And you see the changes to the statutory audit regime, the rotation of auditors, the introduction of NFRA, all of those are thanks to that particular concern that happened over the last 10 years before the act actually culminated. So statutory audit is one of the key things. And of course, all of us and many of us are aware it's not a new opportunity, but Companies Act brought in 3 or 4 key changes in the way statutory audit happens. And that opens up opportunities maybe for a wider base of practitioners to enable their clients. First thing that came up is fixed tenure. Now an auditor is appointed for 5 years, it's a block. So essentially you can put your foot down against concerns that you have against that auditee, and there's much less right that the management has to remove you prior to the end of your tenure. So fixed tenure gives certainty. Joint audits. Now this has been one of the areas that Companies Act promulgated. In fact, there is a provision to say that if the shareholders pass a resolution that the company should have mandatory joint audit, then the management will be bound to adopt joint audits. More and more, we are seeing the concept of joint audit gather speed. Just like when independent directors were there, we had a very limited set of independent directors. Today, almost half of the board comprises of independent directors. So there is a feeling that if there are more than one auditors, there is less risk in terms of one of the auditors having a discussion or anything else. And essentially, joint audit is one of the things that the regulators have been thinking through. The recent introduction by RBI into banks, NBFCs, and mandating joint audits has also been a step in that direction. As we speak, the Ministry of Corporate Affairs, or MCA, has a committee that is deliberating on applicability of joint audits amongst various other changes to the statutory audit regime. So joint audit came in much more force through the Companies Act. Rotation of audits came in. Needless to say, there are opportunities that kind of come in, and one can contribute towards enabling commerce through rotation of audit. And the fourth one is maybe perhaps for the first time in a law is separation of assurance from consulting. Now, this also has been a slightly global trend where in UK there is a proper diktat and a time-bound process wherein firms will have to have Chinese walls and separate assurance and consulting. And we now have our section 144 in the Companies Act, which says that certain services which cannot be given by an auditor. Most of the services which cannot be given are consulting in nature or which affect the independence of that auditor. In fact, even management services cannot be given by a particular auditor. And management service, as the regulator sees, as NFRA sees in one of the orders that has recently come out in the case of Deloitte Haskins and Sells, says that whatever is something that is considered you stepping into the shoes of management is considered as management service. So essentially a tax representation as per that definition would also get into management services. A lot of representation has been made against that particular interpretation of the NFRA, but as it stands right now, management services has been very broadly interpreted. So there will be opportunity for firms to focus on assurance, and there'll be opportunities for firm to focus on consulting. And essentially, there will be this distinction that more and more will start getting clear because of the Companies Act. The Companies Act also introduced internal audit for the first time mandated by law. Earlier, it was more from a CARO reporting perspective and slightly optional. But now Companies Act mandates certain companies to have a formal internal audit framework. It mandates all listed companies, but also mandates certain public companies and large private companies as well. Keep in mind, this is not an exclusive domain of chartered accountants. Even cost accountants, company secretaries, other professionals can act as internal auditors for that company. It is also not mandatory for it to be a practicing chartered accountant. Even an employee who is a member but an employee of that company can have an in-house internal audit function that is conducted within that particular entity. The CFO, or a mandatory position of CFO, comes in for the first time under Companies Act, and he's a KMP. Again, not something that is restricted to chartered accountants, but the fact that chartered accountants are best placed to become a CFO, and now a statutory recognition helps in that cause. There are a few accounting related opportunities that came because of the Companies Act, and some of them are still continuing. For example, Ind AS. Now, as we see, we have two set of accounting standards. One is for not so large companies, and second is the Ind AS for large companies. What is happening is that while there was this phase 1, phase 2, phase 3, and all companies have now traveled into Ind AS, the larger ones, every now and then, whenever that threshold of companies is met, they need to upgrade from a normal GAAP to Ind AS. And there is an occasion for chartered accountants to contribute into that conversion from a normal GAAP to Ind AS. Companies Act brought in mandatory consolidation. As you would recollect, under the 1956 Act and even under the old accounting standards, it was not mandatory to consolidate unless you are a listed company, but Companies Act brought in this requirement of mandatory consolidation. ICFR, as all of us know, Internal Control and Financial Reporting, and CARO, the recently amended and updated CARO as well, has an opportunity for chartered accountants to delve deep into a particular company and report the findings that they have through this CARO reporting. A big Companies Act opportunity or a corporate law opportunity for chartered accountants is corporate reorganization, be it inorganic in terms of merger acquisitions or transaction, or be it internal in terms of restructuring or realignment. I think to my mind, this is a domain, though statutorily doesn't require a chartered accountant, but more practically and technically, it is only a chartered accountant who can do justice to this particular role. Because it's a combination of finance, legal, accounting, and tax that requires a skill sets into that reorganization. Schemes of arrangement, though they are a legal document, have a complete accounting, finance, legal, and tax implication. Because of which the chartered accountants being best placed, earlier what used to happen is that the CAs used to do the reorganization, draft the scheme, but ultimately have an advocate to stand in the High Court company's bench and make sure that the scheme is processed. Now, as a chartered accountant, you are equipped to think through the designing of it, draft the scheme of arrangement, and also go forward and appear before the NCLT and have the scheme passed. So it's 360 degrees that you can do in the corporate reorganization. The Companies Act also brought in cross-border reorganization. So now you can have Indian companies merged into foreign companies merging into Indian companies, and all of that is something that has been enabled in terms of reorganization, where chartered accountants are perhaps only placed to help and do justice to their clients. Some of the other smaller avenues under Companies Act remain acting as scrutinizer for postal ballot and e-voting. If there are any concerns in terms of non-compliances, then the ROC and the RD now have this internal adjudication mechanism, or IAM, or you can go for compounding with the ROC and RD. Again, not required for any other professionals. Chartered accountant can themselves represent and get this done. Quite a few times there are conversions which happen in terms of companies wanting to convert themselves into LLPs, or LLPs wanting to upgrade themselves into companies, or from Section 8 to normal companies. All of that is possible through a chartered accountant, and an opportunity for chartered accountant to enable conversions and upgrade and downgrade. The recent change on withholding taxes on dividend has also brought about an opportunity wherein large companies who have multiple shareholders, like for example, a listed company, may have shareholders across multiple countries, and India may have treaties with those multiple countries. And not only the corporate law compliances on dividend, but also the withholding taxes on each of these shareholder payments of dividend becomes an important compliance criteria. And withholding that, paying to the government 15 CA, 15 CB, all of that are dividend compliances, and many firms have started helping their clients in terms of dividend compliances and withholding taxes thereon. Compliance audit and compliance advisory is an evergreen initiative or advisory that you can continue with your clients. Any corporate action that your clients wants to do, be it as small as raising a loan, you will have compliances of passing resolutions, creating charges, filing forms with the ROC, taking shareholders approval, or even some of the other corporate actions like a buyback or fundraising initiatives or appointing of a managing director. All of them in the corporate setup have certain advisory role. And some of these things are so complex from the Indian situation that an annual audit is also something that companies are now embarking upon. Not only is the Companies Act now more dynamic than the 2000 and than the 1956 Act, it is also complex in terms of its interpretation. It's been about 6 years that the new Act has come in, but there are almost 350 amendments that have come in through way of rules, circulars, notifications, and actual amendments to the Act that have also happened. So it's more dynamic, and hence there is a chance of any miss out, and compliance audit is something that can be considered. Chartered accountants can also contribute in terms of enabling or helping their clients to strike off, wind up, and close companies. This is also somewhere where there is a requirement of a chartered accountant certificate in terms of liquidation and accounts that are prepared for liquidation, but closure of companies is one of the other aspect, and opinions and interpretation. In India, not many things are straightforward. You can always have different views, and opinions and interpretation is something that continues to remain as an opportunity to contribute in the Companies Act domain. I tried to go through the Companies Act and the rules just to identify how many occasions of certifications are there under the Companies Act, and I tried to make a list out of it. I could at least identify 12, 11 of them, and there could be many more. But right from incorporation of the company being the first one till the last one, which is removal of the name of the company, you will see that at various occasions you need certifications from chartered accountants. So incorporation or commencement of business, anytime you issue new shares, you accept deposits or loans, if you have a scheme of arrangement, accounting treatment in the scheme. For Section 8 company, there are 2 certificates. For GDRs, for dormant companies. So across the landscape from birth to death, you will have a scope for an opportunity for certification if you are aware that this is a requirement, and hence being able to better position to ensure that the clients do that compliance. Similarly, the LLP Act also has various certifications, just like the Companies Act has, though they are less in number, but certainly there are quite a few business as usual certificates that are required under the LLP Act as well. We go to the next subtopic on opportunities under securities law. Predominantly involves listed entities and entities which are traded on public markets. But the first one here is helping companies to raise resources. I think while compliance is a large part of what we do, we get satisfaction and reward only in a situation where we are able to actively contribute towards a positive growth for that particular venture, business, or client. And enabling a capital market initiative or helping a client to raise resources from the IPO market is much more satisfying than filing a form which is compliance oriented. So acting as an IPO advisor is one of the roles that many chartered accountants get into. It would mean that you would be involved in spearheading that entire initiative and making sure that the company is able to list its securities on the public markets. Recently, we have been seeing many startup companies and many IPOs coming, and this is a thing that many advisors are working towards. If you feel that IPO advisory is a much larger gamut of technical things that you need, then you can focus maybe on acting as a IPO accounting advisor. Because from an IPO perspective, there is a need to recast the accounting statements or the financial statements for the last 3 years. And you are also required to give additional disclosures, which you may not have given in your previous financial statements, or the current applicable accounting policies would need to be retrospectively applied to a financial number that is 3 years before. And it's the job of this accounting advisor to make sure that this restatement for the last 3 years is done, and then the statutory audit can come and review that. The company's accounting team is unfortunately generally not equipped to do these restatements because the IPO only comes once in a lifetime of that particular company. And you can't expect the internal CFO and the accounting team to be equipped with some of the nuances, which is where you'll generally have an IPO advisor or an accounting advisor help in these matters. A IPO process also has an opportunity for a special purpose expert. For example, under the SEBI ICDR requirements, there's a definition of expert. And if you are relying on any topic on an expert, for example, there could be a major tax litigation that requires a disclosure. And the company would then have to rely on a chartered accountant to give his report. He becomes the expert, and basis of that, he will also form a part of an expert under that prospectus. Or sometimes there are reports which are required for tax benefits available to that issuer, or what would be the tax implication on the shareholders who would invest into the shares of the company. All of those reports can be done by this special purpose expert. And similarly, SEBI ICDR requires various certifications. There are about 25, 27 certifications that the merchant bankers and SEBI requires as a part of the IPO process. And chartered accountants generally will be best equipped for that. There's a general preference to work with peer-reviewed firms, and if there is a peer review, that certainly helps. Apart from fundraising or IPO, a lot of action happens on takeovers, where a company would want to, where an acquirer would want to buy more than 25% shares of a company, is required to give a mandatory open offer. So at what minimum value should be the open offer? What should be the valuation? All of those are governed by the SEBI substantial acquisition of shares and takeover regulation, and pricing of the open offer should also be certified by the chartered accountants. Similarly, as we all know, limited review of listed companies on a quarterly basis doesn't come from the Companies Act, but comes from the Securities Law. And many firms who are essentially working on listed companies or even unlisted subsidiaries need to prepare their financial statements on a quarterly basis, and limited review is something that is required for those entities. Similarly, certifications for corporate actions like buyback, bonus, issue of shares, and for various other things, there's a requirement for having a chartered accountant certificate. In fact, the securities law depend much more on chartered accountants than maybe some of the other professionals, and even the instances of certification are much more than maybe what is there under the Companies Act. Change in name of a listed company. Many of the veterans attending this program would remember that in the 2000 or the late 90s, there was a tech boom, and many companies started changing their name to software and information technology, and their prices would just go high because the name of the company was reflecting information technology. From that time, SEBI has brought in this requirement that any change in the listed company's name, at least a large part of the revenues of that entity should come from that vertical. So if you want to name your company as a healthcare or a fintech startup, you would need to make sure that a large portion of your revenues are actually coming from that stream. And there is a certificate requirement of chartered accountant that the revenues actually reflect the name of that entity. Similarly, the corporate governance report, which is an annual report, which comes in the annual report as well, and certification thereon, something that chartered accountants, statutory auditors can do. It's a detailed report and covers the disclosures and compliances of LODR, which is similar to the erstwhile Clause 49. Not only companies, but there are various intermediaries in the securities market, like a stockbroker, a portfolio manager, a research analyst, or an alternative investment fund, a REIT, a InvIT. All of them have different requirements of a chartered accountant. And every regulation has its own independent dependency on a chartered accountant. And hence the opportunity from a securities law, if one is able to focus on that domain a little bit, is significant to my mind, much more than what is there under the Companies Act, because securities law requires a slightly more deeper technical knowledge than your Companies Act, and which would mean that less number of professionals are able to work with you on those highly technical aspects. Few of the new things that we are seeing in securities law is helping set up entities in the IFSC, or the International Financial Services Center, or the GIFT City, which is now there. Now, setting up over there also has different requirements from Companies Act. There's a domain of SEBI as well, where that requirement is there. There's also RBI that comes into in terms of foreign exchange remittance and repatriation. So it's becoming a slightly technical and a very nuancical thing of setting up entities in IFSC or GIFT City, and we are seeing professionals practice. Vikas and others are from Ahmedabad, and you are at the heart of it. But certainly, setting up entities in IFSC or GIFT City is something that is one of the engaging landscapes that we have. Application for informal guidance. A very interesting thing in securities law is that you can ask the regulator, you can ask SEBI that if this is a particular matter of interpretation, how should I interpret it? And more often than not, SEBI will guide you that on an informal way, of course, in writing, that this is how I see. However, final call is something that is up to you. All these informal guidances are also available for public viewing on SEBI's website. But generally, we see professionals getting involved in terms of drafting of that informal guidance. We have also seen SEBI having one-on-one discussions before they actually come out with that informal guidance, and then representing your client's case with SEBI for obtaining that informal guidance can be one of the areas that can be an opportunity for contribution. For ESOP or sweat equity, large listed companies or more and more even startups are getting into ESOPs and sweat equity. There is a requirement for chartered accountant certificate that they are in compliance with applicable regulations. And also there is a valuation requirement, which we will cover in the slightly different section of registered valuer. SEBI settlement mechanism and adjudication. Like we saw in the ROC, you have the internal adjudication mechanism and compounding. That necessarily means that you have to acknowledge that there has been a particular breach. I have not complied with a particular provision of law, and hence you are going for compounding. SEBI has a slightly different mechanism, which is a without acknowledgement settlement. So if there is a particular view or a show cause notice that you have received from SEBI, you can evaluate that without acknowledging, just to make sure that you don't go through the process, just to make sure that this being more of an economic offense, you can settle it by paying the settlement fees. SEBI settlement mechanism is a window available, and professionals can contribute in terms of making sure that the settlement is achieved rather than a detailed litigation or adjudication process. If it goes to adjudication, certainly chartered accountants can again help in terms of SEBI and SAT. SEBI also has various exemptions. For example, if you are transferring shares between related entities or promoter entities, then you don't have to go for an open offer. Or sometimes there are exemptions that one would want in terms of very specific requirements under the buyback regulations or the delisting regulations. In fact, all the regulations of SEBI generally have a clause to say that power to remove difficulty, and one can approach SEBI and request for a specific exemption if you feel that a particular section or a requirement is something that is not working, or something that is not implementable. And SEBI exemption application is something that are again drafted by professionals and chartered accountants, and one more opportunity to contribute in the securities law. The next basket, friends, is the registered valuer. Many of us would know that about 2 years before, chartered accountants who had the sole domain of valuation, by and large, at least in the securities and the financial assets class, now a new professional came in, which is the registered valuer, and the institute also has its own registered valuation organization now, the RVO, and they are now regulated by IBBI. From a very high level perspective, it's a good development, because earlier you had multiple professionals doing different valuations under different acts and under different methods. For example, if it was a foreign company wanting to buy shares of an Indian company. Earlier, you would have had a chartered accountant who would have done under FEMA, or if it is beyond a particular size under FEMA, then a merchant banker is required. Then under Companies Act, a chartered accountant with more than 10 years of experience would have to certify if it is a fresh issuance. Then under Income Tax Act 56(2)10, you would have a third person who would value. And if it is a listed company, again in SEBI, you would have a merchant banker who would be required. So you had different professionals valuing under different acts using different methods. So there was a clear need to consolidate, and all of that got done, at least started with the registered valuer framework that came in. And chartered accountants are eligible to become registered valuers, especially in the securities and the financial assets class. There are three classes now: SAFA, or the securities and financial assets. You have plant and machinery, and you have land and building. And each of these classes needs a separate registration and requires a separate examination to get passed, and then you can do valuation on that class. From a corporate law or a Companies Act perspective, there are 5 instances where you need report of a registered valuer. So if you have a registered valuer certificate, even being a practicing chartered accountant, you can be a registered valuer as well. And any preferential issue of share, that is any further issue of shares, will require a registered valuer's report. If there is a merger acquisition, the swap ratio that comes requires registered valuer report. Any non-cash transaction with directors requires the report of the registered valuer. In liquidation, it requires report. And purchase of minority shareholding under Section 236. Now, this is one of the provisions which is similar to a listed company, where in a listed company, if someone buys more than 25% of shares, there is a requirement to give an open offer. And you need to also buy minimum number of shares from the other minority shareholders. 236 is a similar obligation under Companies Act, where if someone acquires more than 90% shares in a company, that individual will also need to give an offer for buying the balance 10% out. And at what value? That value will be determined by the registered valuer. Similarly, under the LLP Act, sometimes partners are entitled to contribute in kind into the partnership, into the LLP, and that valuation needs to be conducted by a registered valuer. And under IBC, the CIRP process, or the corporate insolvency resolution process under IBC, also recognizes the registered valuer. There is a concept of liquidation value that needs to be certified by the registered valuer, and there's a concept of fair value. Both of them need to be confirmed by the registered valuer. In fact, the regulator for RPs, which is the resolution professional, and the regulator for RVs, which is the registered valuer, is IBBI at the moment. Going forward, there are plans that the valuers will be regulated by a different set of regulatory body, but right now IBBI is going ahead and regulating. And very soon, we will have other regulators also considering adopting the RV framework. Recently, in some provisions of FEMA and income tax, we have registered valuer coming in. SEBI is also contemplating to have the registered valuer as a framework. So I think by and large, chartered accountants standalone going forward may not be able to do valuation, but there is of course an opportunity to equip yourself and top it up with the registered valuer certification so that you can continue to do the registered valuation, especially in the securities and financial assets class. Also, you can then tie up with valuers who are doing land and building and plant and machinery and give a holistic valuation rather than our earlier domain of just a share valuation or a finance valuation. Coming to insolvency and bankruptcy code, to my mind, in terms of the quantum of work or in terms of the rewards that are there in terms of professionals, IBC stands out at least over the last 3-4 years. The first role that one can get into or consider contributing is acting as a resolution professional. There are so many companies that are going through IBC, and there are so many companies who are in the process of going through NCLT. So much so that for the last 1 year, the government had to put a pause because of coronavirus in terms of initiating any fresh proceedings under the CIRP. But now that has opened up, and we are seeing NCLT taking new matters of IBC as well. A resolution professional certainly requires different skill sets. One would need to equip themselves in that skill set, but I think from an opportunity to contribute perspective, certainly resolution professional is one thing that comes to mind. If the risk appetite or your skill sets don't match to act as a resolution professional, there are various advisory roles which are in the periphery of the IBC. You can act as an advisor to the resolution professional, which is generally done by the insolvency professional entity or the IPE. You can choose to act as advisors to the resolution applicant. Resolution applicant is a person who is wanting to bid for that particular company. For example, in SR Steel, which was the corporate debtor, ArcelorMittal was the resolution applicant. And generally, there are multiple resolution applicants, and only one of them becomes successful. So you can choose to advise a resolution applicant, helping him and making sure that he understands the nuances of IBC, what liability will come, what will not come, making and drafting a resolution plan, which is a very important document because going forward, the resolution plan is something that is going to be sacrosanct because it comes as a part of the NCLT order. So you can choose to be advisors to the resolution applicant. We are also seeing management of corporate debtor appoint their own advisors, and there is an occasion to act as advisor to corporate debtor. And similarly, the committee of creditors, which is the COC, also requires its own advisors. For people who are slightly not familiar with IBC, some of these jargons may sound a little different, but essentially these are advisors working in different capacities. And because the framework involves a haircut, people usually are more dependent on a second opinion, advisory, and making sure that they take the right decision. And because there are differing aspirations, intentions, and directions, we see multiple advisors coming into the play, and something that is an opportunity to contribute. Similarly, IBC requires a transaction auditor to be appointed who would go through the transaction for the last 6 months, 1 year, 2 years, and comes out with any transactions which are not in the ordinary course of business. And there's also a role of a forensic auditor, where in certain situations, the RP will appoint a forensic auditor, and the forensic auditor may go back 8 years, 7 years, 6 years to go through the records of the company just to make sure that there are no fraudulent transactions that the old promoter has done. A large part of opportunity also lies in pre-insolvency advisory. Whether a company gets into insolvency, representing in the IBC, in the NCLT, defending from a corporate debtor's perspective, because nowadays IBC has also become a route to recover money from companies. Because you need, let's say, a very small amount of 1 crore, which earlier was in fact much smaller at 1 lakh, and any creditor worth that small number can file a petition in the NCLT to wind up that company. We have seen instances of petition against Flipkart and various other marquee names as well going through the NCLT, and which is where pre-insolvency advisory or sometimes making sure what actions need to be taken before a imminent insolvency, all of that are opportunities to contribute. And a last part in IBC is voluntary liquidation. So Companies Act allows strike off of name of the company, closure of the company, but you could also do a voluntary liquidation through IBC. That's what also the Companies Act points towards. And the same resolution professional will do a voluntary liquidation under IBC. So there's no creditor action, there is no COC. It will be a voluntary liquidation through IBC, and again a much more docile, de-risk kind of a way of for a resolution professional. I think I have 10 more minutes. I'll rush a bit so that I finish in time. But the fifth aspect was representation. And because of NCLT coming in, chartered accountants can now represent with any NCLT across the country and even the NCLAT. And in fact, to my mind, this puts chartered accountants maybe at a slight edge even in compared to lawyers, because there are some technical difficulties in lawyers getting attached to a particular bar council. Like a lawyer in Maharashtra would be the Bar Council of Maharashtra and Goa. Someone in Gujarat may be predominantly associated with the Bar Council of Gujarat. But a chartered accountant degree, being pan India, allows you to file a memorandum of representation Similar to what is Wakalatnama for lawyers, Memorandum of Representation is for chartered accountant and company secretaries who want to appear, and it is valid for all NCLTs and including the principal bench and the appellate bench, which is at Delhi. Similarly, in SEBI and SAT, again being tribunals, chartered accountants are valid to appear before SEBI and SAT as well, and this opens significant scope for representations. The scheme of arrangement involving merger, acquisitions, demerger, reduction of capital, all of that can now be end-to-end handled with a representation capability that one may develop. And most of the matters in representation are not argumentative, are not so technical, they are procedural, and one can always rely to start with on counsels if at all there is any difficulty. But certainly representation should not be ruled out from the perspective of chartered accountants and their ability. Class action suits, something that is now seeing the light of the day, but we are seeing litigations happening, and chartered accountants can even act as defending their clients in class action suits. Similarly, inter-shareholder disputes, operation and mismanagement. I know a few chartered accountants who specialize only in operation and mismanagement matters and doing much good for themselves. Change in registered office of a company requires again to go to the NCLT, in sometimes the RD, to make sure that you have that particular approval, especially when it involves from one state to another. And these are not technical aspects. You just need to go there, represent, and make sure that you get the NCLT order. Chartered accountants are also eligible to become technical member of a tribunal. Now, generally in NCLT, there are two members. There is a technical member and there is a judicial member. As far as a technical member is concerned, even a chartered accountant who has 15 years of continuous experience can become a member of the tribunal. Similarly, the Companies Act has a process of mediation and conciliation, and there's a panel that the MCA has set up, and chartered accountant with 15 years of experience can also empanel themselves as mediators and conciliators. Last point in representation is NFRA representation. Now, until now, the ICAI and the disciplinary body has been there, but for larger audits and larger concerns, now the disciplinary body or the disciplinary agency is NFRA. And NFRA is slightly distinct from the ICAI, where it is more bureaucratic, more regulated, similar to the MCA, and because of which one would need specialist representation abilities against the NFRA. Earlier, there was a proposal that appeal from the NFRA would lie to NFRAT, which is the National Financial Reporting Appellate Authority, but now that is no longer there. Appeals from NFRA order again go to NCLAT. So one can represent against NFRA and one can also then represent a matter in NCLAT. Here as well, chartered accountants are best placed because we understand the technical nuances. If an auditor has been particularly found questioning or there's some allegation, we as chartered accountants would be able to see better what is merit in that particular issue and then decide on the representation strategy. Last but by no means least is the ESG avenue that opens up, which is environment, social, and governance. Again, a part of the corporate law landscape. We have been seeing chartered accountants and firms engage in devising and designing the governance framework in terms of the board composition, the independent directors, the various policies that need to be set in, and then testing and implementing the operating effectiveness of the policy is a large part of governance that one can focus on. Similarly, independent directors is an avenue and again a big opportunity for chartered accountants. It comes with its own occupational hazards, which most of us are aware about. But if you are able to contribute to a good set of companies, there is an opportunity for independent directorship roles. In fact, now with the mandate of women directors and audit committee mandatorily having someone from the financial background, a chartered accountants are best placed to be a part of audit committee or maybe even chair them. Related party certifications and arm's length review has been an important part of governance in the ESG framework, and more often than not, boards would rely on chartered accountants to certify that the related party transactions are at arm's length and they are in the ordinary course of business or not. And that is one certificate that most of the boards would insist, and something that is an opportunity for chartered accountants to contribute. A new avenue of opportunity to contribute is stakeholder communication and positioning. Now, typically, an annual report, which earlier used to be a black boundary financial number, is now getting into a speaking communication. And there would be various sections in that financial statements. And there is an opportunity for chartered accountants to outgrow the F pages or the financial pages into designing and communicating the overall annual report. Because once you understand numbers, some of the other business aspect can also be extended to. On the S part or the social part, CSR advisory, I think talked about a lot, and we had a session earlier as well. I'll not delve into that, but there is a shift from comply or explain approach to now a mandatory spend approach. So earlier, if you will not spend, you will disclose in your accounts, just like dividend, that the directors don't feel the need to declare a dividend. But now in CSR, you can't take a comply or explain approach. You will then need to mandatorily transfer to the Pradhan Mantri fund if at all you are not able to transfer. So more and more people would actually get into involving themselves and spending themselves. And certainly a requirement of CSR advisory will be there. There's a new requirement of impact assessment. Companies which are spending more than 10 crores of CSR, every project that they do for more than 1 crore will require an independent body to do an impact assessment of what that impact has been out of that spend. And there's no mandatory requirement of any professional. And I think chartered accountants can consider this as an opportunity to contribute. Similarly, trust and Section 8 companies which want to take CSR funds need to empanel themselves by filing this form CSR1. And again, that needs to be attested by chartered accountants. The last part of what I wanted to discuss was this new SEBI requirement of business responsibility and sustainability reporting, which is BRSR. And earlier, SEBI had a mandate of business responsibility report, and which was applicable to only the top 200 companies. Now, BRSR, in its new avatar, has been extended to top 1,000 companies by market cap. It is voluntary for the year 2021-22, but it is mandatory for the year 2022-23. And top 1,000 listed companies would by and large include companies whose turnover is, let's say, even 300, 400 crores. So essentially, these companies would get covered. And it's a large universe, almost 35% of Nifty companies will get covered by this reporting. Now, this reporting is basically in lines with some of the international reporting frameworks of GRI, which is the Global Reporting Initiative, or Sustainability Accounting Standard Board, or the integrated reporting. So if companies have already been doing reporting under any of these international frameworks, they don't have to redo BRSR reporting. They can just link the principles and make sure that their earlier reporting continues. So there is interportability in that sense. The SEBI circular of May 2021 has a 35-page format in which that reporting needs to be done. And there is a 33-page guidance note that is also there as a part of the circular. So expect the annual report to be further beefed up because of this particular disclosure requirement. You can give this disclosure in your standalone financial statements or on your consolidated financial statements, as long as you do it consistently. It can't be 1 year is standalone and the second year is consolidated. And there are earmarked questions which are there, and your responses to those questions need to be clear, complete, and concise. What they say is that there are 9 principles, and businesses needs to report on those 9 principles. And these 9 principles are laid down in this national guidelines which are applicable to India. Each of these 9 principles have certain essential indicators and certain leadership indicators. Essential indicators are mandatory. So let's say the first principle is that business should conduct and govern themselves with integrity. In that first principle, there will be some indicators which are essential, and every company needs to mandatorily report whether they are complying with that or not. In the same principle, there will be some leadership indicators or leadership question. Those will be optional, whether an entity wants to give any response to that particular leadership indicators or not. I'll not go through the 9 principles because they're very much there and we are running out of time. But the disclosure, which is a 35-page disclosure, has three sections. One is the general disclosures, the second is the management and process disclosures, and third is the principle-wise performance disclosures. Now, if we see the general disclosures, most of the part covers around governance, that whether you have independent director framework, whether you have policies, how many employees do you have, how many workmen do you have. So to my mind, if one sees ESG, the S part and the G part is something that as chartered accountants, we would be really equipped to contribute. Maybe there would be some support required on the environment part, to some extent on the S part as well, but a large part of governance related disclosures is something that we as chartered accountants can contribute. And going forward, ESG reporting is going to be mandatory for most of the companies and most of the businesses. In fact, MCA has now come up with ESG for MSMEs, and there will be significant disclosures that will come, and early initiatives around the ESG thing will also be an interesting opportunity for chartered accountants to look at. So friends, I think I have overshot my time by 3 minutes, but I hope that I have been able to do justice and share some insights into various opportunities available. Each of this is a different domain altogether, and not something that can be done with a left-hand job. Make sure that you develop the requisite skill sets and then get into it rather than learning at the cost of the client. Thank you very much for giving me a patient listening, and thank you for the organizing team for having me here. Over to you, Vikas bhai.
Vikas sir. Sanjay sir.
Yes, I'm there.
Sir, Anand sir ko out of thanks kare sir.
Yeah, sure. Very warm good evening to one and all. Friends, just now we heard Anand sir. It was very meticulous and very well prepared presentation we had. Sir, Anand sir, you have very well justified the topic and explained the nitty-gritties, and also very nicely elaborated the opportunities for chartered accountants in various fields in corporate law practice. So on behalf of the organizers, I extend my sincere gratitude to you, sir, for investing and sharing your time space for us. And your contribution to today's webinar is invaluable for us. And I'm quite confident that your words of wisdom will definitely help our members in their day-to-day practice. Thank you very much for accepting our invitation and enlightening us. Thank you, sir.
Thank you, Sanjay ji, and all the best for the rest of the program. Thank you very much. Thank you.
Thank you. Welcome, Rahul Parikh, sir.
Thank you.
Mishra ji.
संजय सर 2 मिनट 2 सेकंड सर आपको भेज रहे सर.
Yes, please. Yes, please.
2 सेकंड सर.
Rahul ji, आपका presentation is ready. You're ready with presentation?
Yeah, actually, that's yeah. Just hold on.
Yeah.
So sharing का option कहाँ? Yeah.
राहुल सर आपको शेयर स्क्रीन दिया सर?
या एक मिनट
सर आपका पीपीटी ऑन करिए।
Is it visible?
सर स्लाइड शो पे करिए सर।
Slide show पे है नहीं दिख रहा, एक मिनट।
संजय सर।
या
हाँ सर
Okay.
आपको भी किया सर, मेल भी किया सर आपको।
Yes, I got it.
Okay.
So, friends, now we will start our second session of the day. I welcome you again for our second session. Friends, today, presently we have with us CA Rahul Parikh sir. He is going to deliberate his knowledge with us on the topic concept of fast track mergers and procedural aspect. Friends, Rahul Parikh sir is a very known faculty in the field of corridors of WRC and ICAI. He doesn't need any formal introduction, but still for those who are new, I'll introduce him very briefly. Rahul Parikh sir is a Bachelor of Commerce with 65% marks in the Maharaja Surjara University, Baroda, fellow member of Institute of Chartered Accountants. He has acquired a diploma in information system audits, awarded the Ganesh Mal Patni Memorial Prize for the best paper in statistics in CA Foundation exam. Also secured 44th rank in All India Merit List of CA Foundation exam. Secured 43rd rank in All India Merit List of CA Intermediate exam. In professional practice since August 98. Around 23 years experience in this field. Partner of Parikh Shah, Chotalia and Associate. Qualified insolvency professional and member of the Indian Institute of Insolvency Professionals of ICAI. He has vast experience in various fields of practice, consultancy in implementation of ERP system, including SAP and other integrated software systems, setting up and implementation of management information system for better control over the business, setting up and implementation of costing system, including past performance analysis and future products. Friends, he has big list of practical exposure on various assignments. Other activities like he has been member of a managing committee of the Baroda branch of WRC of ICAI since 2004 and has held various positions in the branch, including treasurer, secretary, vice chairman, and chairman. Under his tenure as chairman of the Baroda branch of Western India WRC Vikasa division in 2009, the branch has awarded the best Vikasa of ICAI. During the tenure as a chairman of the Baroda branch of WRC of ICAI in 2010, the branch has awarded the most commendable performance award by the ICAI. Was co-opted member of taxation committee of the Western India Regional Council of ICAI for 2011-12, was co-opted member of a CP committee of the Western India Regional Council of ICAI for 2013-14, was a member of WRC ICAI COVID-19 Economic Response Study Group, have delivered lectures and presentation on accounting standards, direct tax issues, information technology management, insolvency code, etc. at lecture meetings, seminar organized by ICAI and its regional branches. So it gives me tremendous pleasure to present to you today's faculty, and the performance we have read now is very well known in the fraternity. Dice is yours, sir, and I wish everyone happy learning, and we will be getting words of wisdom from Rahul Parikh, sir.
Thank you. Yeah, thank you, Sanjay ji. First of all, my thanks to Sri Srinivas Joshi, Chairman, Corporate Law and Corporate Governance Committee of ICAI, Anuj Goyal ji, Vice Chairman, Manish Gadia ji, Chairman WRC, and Vishal Doshi, Chairman of Corporate Law and Corporate Governance Committee of WRC, for inviting me to share my views on one aspect of merger process which is still not very well known, or still not very often used by most of us. So even when I first started thinking on this issue, when I suggested this topic, there was a lot, some doubt also in the organizers that whether this topic, how far this topic is going to be effective. But I think in today's scenario, this may now be a very, very important topic for all of us, and maybe a good professional opportunity in this today's economic scenario. I consider this to be any merger is a part of any business restructuring process, and business restructuring is integral to the growth in any economy. So entities would normally undertake restructuring to grow or survive, or in some cases even close businesses. So business restructuring, I would view it as a act of reorganizing either the legal status or the ownership structure or the operational structures. It may be a combination of all these things or either one of them. And the main aim is that the resultant structure should be better suited to the objectives of the organization. Again, the objective may be to improve profit or reduce loss or to achieve growth. So the growth can be again. Growth can be organic, inorganic. So it's all depending on what is the need of the organization. And the structuring, again, this restructuring can take many forms. So one of them is conversion of various forms, say firm to company or LLP to company or company to LLP, or it may be a merger which we are likely to discuss, which we are going to discuss. It may be a demerger, it may be a debt restructuring. It may be internal organization change, or it may be a change of business model also. So that's that's how the business restructuring is a very dynamic field. In if you can say that it has many aspects, and we are going to discuss a very small aspect of the entire gamut. We have about 45 minutes. I hope this would be enough for covering this topic. So first of all, let's go to the base. Why amalgamation or merger? In Companies Act, the term amalgamation and mergers is synonymous. There is no differentiation between the two. And amalgamation basically is the process of either one entity absorbing one or more entity in itself, or two or more entities combining together. So when you are combining, it's a merger. Amalgamation takes into consideration both the aspects. And why would basically one be looking at an amalgamation? The amalgamation normally is carried out for economies of scale, or to achieve synergy, or eliminate competition by absorbing a smaller competitor, or increase of market share. So these are all it's an inorganic way of growing your business, or to achieve cost efficiency. Two or three companies in the same group, they combine and you get cost efficiency, better competitiveness, acquisition of intellectual property or talent, achieve economic strength. So these are the basic or the most common benefits of amalgamation, or the rationale that a company would have behind amalgamating with another company. Okay, so let's move on to the legal provisions. Where is the base coming from? So the legal framework for restructuring for a corporate entity is basically covered in Chapter 15 of the Companies Act 2013, where the sections 230 to 240 lay under the title Compromise, Arrangement and Amalgamations. These are the provisions where you have all mergers, demergers, all kinds of restructuring. Everything is there under this section. And so just to run you through briefly, section 230 is the enabling section for an amalgamation, where a company can approach NCLT. 231 is it lays out the powers of NCLT to enforce any arrangement or compromise under this chapter. 232 is the procedural part for a normal amalgamation. This is the amalgamation where you actually go to NCLT, and that's a regular route of amalgamation. 233 is something which was not there earlier, and this is the fast track amalgamation scheme. The fast track amalgamation scheme is available for a specified category of companies, where instead of the NCLT, you can approach the central government and make an application for approval of merger for 2 or more of such category of companies, the permitted category. And the main important differentiation between a regular amalgamation and this is that, first of all, there is a fast track process, meaning there are time limits for the regulatory authorities also in this to give their opinions or objections, and the most important is there is no approval of NCLT required, so that automatically makes it a faster process as well as a cost effective process. 234 of course deals with cross-border mergers, and the rules which actually lay out the forms and the processes are the Companies Compromise Arrangements and Amalgamation Rules 2016. So, and in this particularly the rule 25 is the one which deals with fast track mergers. So if you look at it from if you are say thinking of a fast track merger, basically you have to study section 233, which is about 11 or 12 subsections, and rule 25. These are the two things which are what you need to study. So even one can joke that even the section and the rules were made on a fast track basis, and sometimes yes, because these are very briefly stated provisions, there are aspects where there is some ambiguity or some clarity or some clashes of the provision also. But on a practical way, once you are going for it, the respective regional directors and ROCs have their are able to guide also where these kind of issues arise, and we can go through that. So there have been actually quite a few successful cases where mergers have taken place under this particular provision. So it is not that this is a completely new concept. This had come in effect from 15th December 2016 when the entire merger process was under 2013 Act was moved from the High Courts to the NCLT. That is when these provisions also came into being. Okay. One more thing that we need to think. Why would you actually another aspect is fast track amalgamation. Why I'm thinking that the time has come. Normal amalgamation always has to go through NCLT. Now NCLT is typically there are two major disadvantages. One is the time taken for that amalgamation, which typically can range from anywhere between 6 to 12 months, depending on which NCLT you are and how burden it is. Because today with IBC cases flooding into NCLT has very little time for merger cases also. So I come to understand that in certain jurisdictions, NCLT go very slow on merger applications because it's not a priority for them right now. And secondly, the cost is prohibitive. NCLT representation in itself is a good counsel can cost you easily cost you a ton of money, and so where you for smaller companies it becomes almost impossible because the cost is with the cost benefit ratio never sets in. With COVID-19 and a lot of churning going on in the economy, one would expect that the need for restructuring for SME companies would also arise. And in such a situation, one can easily use this tool as a fast track amalgamation to provide a low cost solution for SME companies to restructure their business. And why it is also recent, as I'll come into the subsequent slides, the Ministry of Corporate Affairs has also made conscious attempt to expand the scope of this of the companies that would be eligible under this section, because they have recently in February 21 they have amended the definition of a small company and increased the thresholds. Similarly, they have also enabled startup companies to take advantage of this provision. So the pre-February 21 very limited number of companies probably were eligible under this provision, but now the scope has quite increased. So it is important for us to be aware of that. Coming to the associated issues related to an amalgamation. while structuring an amalgamation scheme, we also need to keep in the allied laws that are likely to be applicable. So I'll just quickly run through these two. The first is, of course, naturally the income tax, again, implications at multiple level, and it's a topic in itself. You know, the tax impact or the tax planning in case of amalgamation, the issues that can arise, the care that is to be taken. That is a topic in itself, so I will not go too much into detail, but I have listed out the basic provisions which are likely to impact you in this section 21B, section 47(6), 47(6)AA, section 32, very important, depreciation to be bifurcated between amalgamated companies based on number of days used. Section 72A, which is the enabling section for carry forward of unobserved loss or depreciation. Again, very important to note that only certain type of companies are eligible for carrying forward in an amalgamation. Primarily manufacturing, industrial undertakings, shipping business, hotel, banking. While one important point to be noted, whether you are in a regular amalgamation or a fast track amalgamation, the tax provisions that are applicable remain the same. So that aspect it would remain the same. So there is no differentiation as far as income taxes are concerned, whether it is a fast track transaction, fast track merger, or a regular merger under section 232. The next point that we need to SEBI approval. Okay, so normally in most cases, because of the type of companies covered under fast track mergers, the SEBI approval is not. Those companies are not likely to be listed. The only case where a listed company may be involved is when this fast track is also available to a merger between a holding company and its wholly owned subsidiary. So that is the only case where I think SEBI would actually be involved. Otherwise, SEBI is not involved. So in this particular presentation, I have not given too much weightage to SEBI and the procedures involved in SEBI. The Competition Act 2002, yes, that is also applicable if the amalgamation, if there are certain thresholds for assets and turnover which are crossed. In that case, the prior approval is required. But that is also again not applicable, likely to be applicable in this case, because this framework is primarily available to smaller companies. But yes, if again this framework is being used for merger of a holding company and a wholly owned subsidiary, then yes, Competition Act can come into picture. Otherwise, it would not come into picture. Stamp duty, yes, this is a very, very tricky issue, and especially when and this needs to be it can have large financial implication in terms of cost and needs to be analyzed properly, especially where multiple states are involved. That means the merger may take place in a particular state. Both the companies may be registered in a particular state, but they may have assets outside this state. Or you have a situation where you have the transferor company in one state and transferee company in another state. Now the laws of stamp duty are differ state to state, and in certain states they simply don't even have a specific provision dealing with amalgamation. In such case, normal rates for transfer of immovable property are applied, and so the possibility that there will be double levy of stamp duty is a very real possibility. So that is something that you need to structure and take into consideration before you actually go for a merger proposal, even in case of a fast track merger proposal. So which are the companies who are eligible for this fast track merger framework? So that is provided in section 233 subsection 1. So first of all, 2 or more small companies who are first eligible to use this framework. So small companies is basically defined under section 2 subsection 85. Then a holding company and its wholly owned subsidiary. Now keep in mind it's a wholly owned subsidiary only. Normal subsidiary is not eligible. And such other classes as may be notified. So recently in February 21, they also notified that startup companies would be eligible either to merge within. So you can have a merger of 2 or more startup companies, or you can have a merger of one startup company with 1 or more smaller companies. So within the so one more category added, and it's a welcome addition. So now, as I said, in order to expand the reach of this provision, and recently, again in February 21, they also expanded the definition of a small company. So now a small company means a company whose paid up capital does not exceed 2 crore. This was earlier 50 lakh rupees, and the turnover does not exceed rupees 20 crore. This was earlier 10 crore rupees. So now any company who has a paid up capital below 2 crore and a turnover below 20 crore would be eligible to access this framework. So both the companies being merged have to be small companies. What is a startup company? So startup company would be a private company recognized as a startup in accordance with the DPIIT notification dated 19 February 2019. So under that notification, basically a startup company is a private company who is considered as a startup for a period of 10 years from the date of incorporation. Its turnover does not exceed rupees 100 crores since its incorporation, and it is engaged in innovation, development, or improvement of products, etc., etc. So basically, it should be a private company which is recognized as a DPIIT as per clause 2 of that notification. There are two clauses. First is the regular recognition, and then there is a specific recognition if you want to claim deduction under ATIC. But a regular notification as a startup company would be more than enough for accessing this framework. So what are the benefits of the fast track merger? Then we'll go to the procedural aspects after this. So basically, I would think that first of all, the major benefit is that the mandatory approvals from NCLT is dispensed with, and this means that a lot of cost is saved, a lot of time is also saved. Public advertisements are not required. Again, a lot of cost saving. The period of completion is around 3 months, as against 6 to 12 months taken up in normal amalgamation. So it's a low cost option for business restructuring for smaller companies. Registration of once the scheme is registered by the RD, it has the effect of dissolving the transfer company without any further winding up process. And overall, the paperwork required and the administrative burden on both the companies is much lower as compared to a regular amalgamation process. Because the regular amalgamation process, in addition to the process prescribed under the rules and the law, would also have to comply with NCLT's own processes also. So that is a little cumbersome and time consuming. So let's start with the process. What is the fast track merger process? The first step would, of course, would be like in any other amalgamation. We need to ensure that MOA and AOA both contain enabling clauses which allow amalgamations and mergers. So if that is not the case, then the first step would be, of course, to amend and incorporate the required clauses in MOA. Normally, this in any standard MOA, these clauses are already there. But yes, it is better to check it before you start embark on the merger process. Otherwise, unnecessarily you can find yourself stuck. The next step would be getting a board approval. So this is the meeting. Actually, before this, even this meeting, there probably would be another board meeting where you would actually initiate the proposal of the merger, which would be like an in principle approval that yes, we should consider merging with this company, or we should consider the merger of 2 or more companies. Appointing a valuer, appointing a CA or a CS as a consultant to the process. And then you would come to the stage where you can actually go, you have a draft scheme in your hand and you present to the board. So in this particular meeting, the agenda would be, first of all, first resolving that yes, we should merge. This would be the appointed date. The appointed date is the date from which the merger actually takes effect. So there are 2 dates normally in a merger. One is the appointed date and second is the effective date. I'll come to both dates at the end of this process, once we have discussed the entire process. So in this case, the first the board meeting would first the board would be approving the proposal of the merger. It would be approving the valuation report and the exchange ratio which is determined pursuant to that valuation report. It would then be approving the scheme of amalgamation and also authorize a board member to perform all acts and sign such documents as may be necessary for executing the merger process. There will be so many documents that may be required to be signed. and so we need to authorize one or more board members to sign those. And it would also, if possible, this is again depending, you may do it in a separate meeting also, but it would also need to fix the date, time and place of convening the meeting of shareholders and also for the creditors. So as I said, the last 2 points, they may be taken up at a different board meeting, because a lot of times before you can actually convey the meeting of the shareholders and creditors, in this process you need to achieve some other, you complete certain other steps, and if the timeline for those steps is still not very certain, then you may not be able to fix up these dates. So step 3, the step 3 is first filing the draft merger scheme for comments and objections of the respective ROCs and the official liquidator. So the notice of the proposed scheme along with the draft scheme of merger will be filed in so basically what you will be doing is you will be issuing a notice to the respective ROCs and the official liquidator that we are proposing a scheme of merger between these two companies, and the merger scheme is enclosed. So the notice is in form CAA 9, and in case of ROC, both the transferor and transferee companies have to file with the ROC. And so if a transferor and transferee companies are located in 2 different ROCs, then in both ROCs you would have to file. It would be filed with form GNL1, which is a general form basically. If for it's a general purpose form for filing miscellaneous documents. In case of the official liquidator, of course, the transferor company, the OL is concerned with the transferor company. So you have to file the notice of the merger scheme in CA 9 and the merger scheme with the official liquidator in whose jurisdiction the registered office of the transferor company is located, to be filed by hand delivery or by registered post or speed post. And there is a third clause in the section which says any person who is likely to be affected by the proposed scheme. Now, this is one area where there is no further guidance anywhere in the law or the rules that as to who would be the persons who would be affected, and so to whom do we actually serve this notice. And because since the public notice is not required as of now, normally every RD would be specifying something different, but as of now, I think the only people involved are the registered ROC and the OL. So now, having served the notice on the ROC and OL, the ROC and OL are required to submit their objections or suggestions within 30 days from the date of filing of form CAA 9, and these are to be given by them to the central government. In this case, the central government is the powers have been delegated by the central government to the regional director, having jurisdiction over the transferee company and not the transferor company, mind you. So the regional director, where the transferee company is registered office, in whose jurisdiction the transferee company is located, the suggestions are to be given by them to the regional director and also to the authorized representative of both the transferor and the transferee company. A very important point, the scheme does not provide for calling from objections from any other statutory authorities such as Income Tax Department, RBI, etc., as is the case in a regular amalgamation process. So the step 4 would be filing the declaration of solvency. Now this is one of the most critical part of the process. Preparing the declaration of solvency, you would be required to list out all the liabilities, including contingent liabilities, and the realizable value of assets against the same. And then, since this declaration of solvency is required to be audited, the realizable values would need to be backed by third-party validations also, because otherwise the auditor is not going to sign. For example, if you are trying to state the realizable value of a land, then you would probably need a valuation report. So the basic intention of this declaration of solvency is that the board of directors should satisfy themselves that the company, both the companies, are capable of meeting their liabilities as and when they fall due, and that the company will remain solvent for a period of 1 year from the date of declaration. So this effectively means that only solvent companies can go for a fast track merger. So the format for declaration of solvency is in Form CAA 10. If you look at that format, you would find that there is a statement of asset and liability to be furnished along with which forms a part of that form, and the statement of asset and liability has book values and then the realizable values against that. So based on that, then you are able to determine whether you have enough assets to basically pay off your liabilities if required. This form CA 10 is to be notarized, and then it is to be e-filed with the ROC along with form GNL 2. And as I said, the form CA 2 requires that the board should declare that they have formed an opinion that the company is capable of meeting its liability as they fall due, and that the company will remain solvent for a period of 1 year from the date of declaration. So both the companies have to do this. The form CA 10 is to be accompanied by an audited statement of the company's assets and liabilities along with an auditor's report. And as I said, this would include the book value of assets, realizable value of assets, liabilities, including contingent liabilities, and what is the likely surplus after payment of these liabilities. The statement of liabilities, assets and liabilities is to be audited and should be as on the date of declaration. That is the date on which the board is forming an opinion and resolving that yes, the company is solvent. That is as of that date, we need the statement of assets and liabilities. So it has almost to be like an up-to-date thing. Step 5. You are now on the, once you have filed the statement of solvency, that is the time after which you can then start convening your meeting of members of both the companies. So separate meetings are required to be conducted for each class of members. A clear 21 days notice is to be given from the date of issue of notice. The objections or suggestions received from the ROCOL to whom the notice in form CA 9 was, our step 3 was issued, are to be considered at this general meeting. And then, so that means that the date of my meeting of members should always be after the expiry of the 30 days from the date of issue of form CA 9. That is a very important point that we need to keep in mind. Like, because I am required to consider the objections or suggestions of the ROC and OL. Now, the members would, at the general meeting, would consider the objections and suggestions from the ROC OL. If nothing is received, it is assumed that there are no objections or suggestions from the ROC OL, and the scheme is then required to be approved by the members holding at least 90% of the total number of shares, with or without modification. With modification would mean that if there is a suggestion from the ROCOL and the members may resolve that the scheme may be appropriately amended, so that is fine also. The term used for approval of members is at least 90% of the total number of shares. So the question that is there is that whether the reference of total number of shares who is to the number of shares who are represented in the general meeting, or is it the total number of shares of the company? Now, this issue is not clarified appropriately, but on a conservative view, looking into the language, one would assume that the reference is to the total number of shares of the company and not to the shares present, shares of members present in the meeting. Also, normally under the regular process, the NCLT exercises its power to sometimes dispense with meetings of members also, where written consents are provided if it deems it to be appropriate. But that kind of option is not given here. That option is available in case of creditors, but that particular option is not given in as far as the members are concerned. So you have to call a meeting of members. You have to have an EOGM, and that's where you have to resolve at least by 90%. So that means getting presence is also important. The list of members normally would be on the date on which the notice is issued, and it would probably be the date on which the solvency declaration is approved by the board. So that's the two dates can coincide. The next step would be then convening the meeting of creditors of both the companies. So again, separate meetings to be conducted for each class of creditors. So secured creditors different, unsecured creditors different. 21 days clear notice, and then scheme is required to be approved by creditors representing 9/10 in value of the creditors in each class. So again, it's 90% in each class. Now here we have an option that instead of calling a meeting, we can obtain written approvals from creditors representing 9/10 in value of the creditors in each class. Again, the term used for approval is at least 9/10 in value of creditor or class of creditors. So one would assume that the reference is to the total value of creditors of the company or as on the date of issue of notice, and not to the value of creditors present in the meeting. Especially because if I am going for written consent, then I would naturally be going for 9/10. I would be going for all the creditors approval. So one more important point, what are the contents of the notice that is being served to the members or creditors while calling the meeting? So first of all, as we have already discussed, at least 21 days notice is required. Now the notice, apart from mentioning the agenda, time and place of the meeting, shall be accompanied by the following. One is the proposed scheme of merger. Second is the explanatory statement as per Rule 6.3 of the company's Compromise, Arrangement and Amalgamation Rules 2016, along with attachment prescribed to the extent it may be applicable. See, this rule is basically meant for the regular amalgamation process where you are actually calling a meeting of the shareholders or the creditors, and there are a number of things have been prescribed that we have to say enclose the previous year's balance sheets, we have to enclose the related party disclosures, the rationale of the merger, etc., etc., and that would mean that but there are certain things also which may not be applicable in this. So to that extent, we have to consider that whatever is not applicable for this process, we may not include in the explanatory statement. And the last is that we have to also furnish the copy of declaration of solvency in Form CAA 10. So these are the contents of the notice which will go to the members and the creditors basically. Step 7, filing of the merger scheme with Form CAA 11. So so assuming that you have conducted the meetings of the members and the creditors and they have approved the scheme by the required majority, then within 7 days from the conclusion of this meeting, the transferee company, keep in mind, only the transferee company should file with the central government, that is the regional director, the following documents in Form RD1. In Form RD1, the first is the scheme of merger as agreed by the shareholders and creditors. See, the earlier scheme was a draft scheme which was furnished to the ROCOL. Now it is a finally approved scheme of merger by the shareholders and creditors. The report of result of each of the meeting, and this report is in form number CAA 11. So these things are to be filed with the regional director. Along with the regional director, simultaneously, these documents will also be filed with the registrar of companies in e-form GNL 1 and with the official liquidator through hand delivery or registered post or speed post. So, but these are the documents which are to be filed only by the transferee company. So that would mean that this document would be filed with the ROC who has jurisdiction over the transferee company. And in case of OL, the OL who has jurisdiction over the transferor company, but the document will be filed by the transferee company. So then we come to the stage where we are looking at the approval of the scheme by regional director. If all goes well, then okay. So The first is that the concerned ROC or OL has 30 days to submit any objections or suggestions that they may have to the approved scheme basically. And if they do not submit any objections or suggestions, then it is presumed that they have no objection. Now, suppose the ROC and OL do not communicate any objection or suggestion, and if the regional director is also of the opinion, or they submit certain objections or suggestions, but the regional director is of the opinion that these objections or suggestions are not sustainable. In that case, the scheme, and he is also of the opinion that the scheme is in public interest or in the interest of the creditor, then the regional director will confirm the scheme and communicate the same to the companies in Form CAA 12. Now, see, there is a debate that goes on is whether the regional director can suggest any changes in the scheme, a scheme which has already been approved by the shareholders and the creditors, based on any objection or suggestions of the ROCOL. But the words used in the act, the provision is confirm. So it would seem that the regional director can only confirm the scheme, and if there is a issue, then he has to go to the next step. Now, if the ROCOL has any objection and suggestion, and if the regional directors feel that this is a sustainable objection or suggestion, then he would form an opinion that the scheme is not in public interest. In such case, the regional director will file an application in Form CA 13 within 60 days from the receipt of the scheme and would refer the matter to NCLT, requesting them to consider the scheme under Section 232, that is a regular amalgamation process. In that case, this whole process gets converted into almost like a regular amalgamation. Now, the order passed by the regional director in Form CAA 12 shall be filed with the respective ROC by both the transferor and transferee company in Form INC 28 within 30 days of the receipt of the order from regional director. So, basically, filing of the Form INC 28 is the issue of Form CA 12 by the regional director is the confirmation that the scheme is coming into effect, and then we are intimating both the ROCs that the regional director has approved the scheme of merger, and so that is in the Form INC 28. So that would be the effective date when the regional director actually confirms the scheme. That is the date on which the transferor company also dissolves, and that would be the effective date of the amalgamation. So some additional points that so this in turn basically completes the entire process. And as I said, yes, so this is definitely something that you can with proper follow-up and adequate preparation, you can easily complete the process in around 3 to 4 months, because everywhere there are time limitations that are specified for objections. So basically the maximum 2 times are 30 days available to ROC for giving their objection. So remaining processes, if we can plan it in such a way, then easily this process can be completed in about 3 to 4 months. Now, some additional points that we need to keep in mind. First of all, demergers are not covered by this section, as the heading of the section itself is relating to merger or amalgamation. Secondly, unlike 232, section 233 does not contain the word reconstruction. So while under section 232, mergers, demergers, everything is possible, section 233 is only for merger. Now, companies eligible for amalgamation under section 233 can always take the regular route of amalgamation. This is specifically provided, and it's logical also that I may not want to go under this route because I may be foreseeing some issues, and that I would like to go through the NCLT route. Section 233(10) specifically provides holding of any treasury stock. What it means is that if in case of any inter-se holdings, it is not the shares will always stand cancelled, which is not the case in section 232. There are some options available. One more important point: the authorized capital of the transferee company shall stand enhanced on account of the merger to the extent of the authorized capital of the transferor company, without payment of additional fees. So that means there will be a merger of the two authorized capitals, and for that no additional stamp duty is payable. Of course, appropriate filing under section 61 will have to be done by the transferring company. So assume that you have the scheme is registered by the regional director. What is the impact? As on the date of registration of the scheme, all assets and liabilities of the transferor company will become the assets and liabilities of the transferring company. Any charge on the assets of the transferor company will become applicable and enforceable in the hands of the transferring company. Any legal proceedings by or against the transferor company shall be continued and will be by and against the transferring company. If the scheme provided for purchase of shares of dissenting shareholders or settlement of debts of dissenting creditors, it is possible that certain shareholders or creditors may actually dissent. And in that case, in order to overcome the dissent, the scheme may provide that they will their shares or their debts will be settled as a part of the scheme itself. That is permissible. And if any of that amount remains unpaid, then that liability will then become the liability of the transferee company. So this basically sums up the entire fast track merger process. And as you can see, it's a relatively simple process and a much faster process. And looking to the scope that has been increased recently, we can always invoke this to actually help out the smaller companies or the startup companies in this, and it's a good professional opportunity for us. Just the summary of forms that are required to be filled in as a part of the fast track merger process. I have, as I said, that you can the form GNL1, where it will basically to be filed with the ROC for the purpose of filing CA9 with the ROC. This would also the CA9 is also to be filed with the official liquidator. GNL2 for filing the declaration of solvency with the ROC. MGT14 would be required for the board resolution and special resolution. The special resolution passed by the EOGF for approving the merger scheme. Again, filing the approved scheme and the report of the meeting in CA11 with GNL1, and this would also have to be filed with the official liquidator. And form RD1 for filing the report of the meeting in CA11. And last is the confirmation order of CA12 to be filed with the ROC in form INC 28. So basically, the CA form are all not e-form; they are all manual forms which you have to print out and fill up and sign and then file along with the relevant e-form as far as the ROC is concerned. And some physical filing is of course involved as far as the official liquidator is concerned. So basically, this in sums up the procedural requirements as far as the fast track merger goes. And I would welcome any questions that any of you would have. But to that extent, I think as you can see, this is a rather simplified process. There are some issues that are still unresolved, but if I think that if more and more people opt for this route of restructuring and merger, then slowly this issue would come to fore, and then there is a very good possibility that MCA would actively start addressing these issues. So again, I thank the organizers and the Corporate Law Committee for inviting me here to present my views. Thank you very much. Over to you, MOC.
Thank you very much, Rahulji. At the outset, let me congratulate WRC for organizing such a nice national conference on corporate laws, and also selecting good topics, and also inviting such distinguished and eminent speaker to deliberate their knowledge with us. It is very much beneficial to all of us. So friends, today's topic, which Rahul Parikh sir has taken, was quite complicated and procedural. But sir, let me tell you, very fluently and with your lucid language, you have explained the procedures. You gave a detailed commentary on section 233. You also touch upon the aspects of NCLT, startups, etc. And you very well explained the procedure with respect to fast track mergers. So we are very much thankful to you for taking out time from your busy schedule for the betterment of the fraternity. You and from our WRC and ICAI and all the delegates attending this webinar, we extend your heartily congratulations and thanks to you for enlightening our members. I'm confident that knowledge shared by you will be beneficial to our members. Thank you very much.
Thank you very much. Thank you, everybody.
So, friend, with this, now we are coming to the third session of day now. And now also a legendary and well-known personality is with us on the forum. None other than Durgesh Kabra ji, a senior most chartered accountant among us, and our very own Central Council member also. So friends, I have a privilege to introduce him for today's upcoming session. It is my honor that I am talking about him. Friends, now sir is going to take a topic on common non-compliances in Schedule 2 and Schedule 3 under Companies Act 2013. Friends, Durgesh Kabra sir actually doesn't need any introduction but still for the sake of knowledge, I'm going to share his brief introduction with you. CA Durgesh Kabra ji is FCA, IP and Central Council member of ICAI. He is chairman of Committee on Insolvency and Bankruptcy Code of ICAI, vice chairman Sustainability Reporting Standards Board of ICAI, convener for Center for Audit Quality, a member of Quality Review Board, vice chairman of Committee for Members in Industry and Business of ICAI, more than 30 years in company law, corporate structuring, management advisory, audit and assurance services. During his chairmanship of WRC in 2012 and 13, WRC received many coveted awards, including the Best Regional Council Award, Best Student Association Award, an avid speaker and an expert in law and bankruptcy code. He has addressed more than 180 seminars, forums, and conferences on company law, LLP, and insolvency and bankruptcy code. A strategist and a leader to the core, he has conceptualized and implemented many initiatives for WRC during his chairmanship. As an active and responsible member of trade industry, he is associated with various social forums as well. So I am pretty sure that the precious knowledge that sir is going to share with us will be benefiting to us. So friends, may I present you a towering personality and today's faculty, CA Durgesh Kabra ji. I request all of you to give big round of applause and welcome him to today's webinar. Sir, kindly take the charge of the session and enlighten us with your words of wisdom. Thank you, sir.
Thank you, Sanjay. It's indeed a pleasure to be part of a National Company Law Refresher course, which is being organized by Western India Regional Council of the Institute of Chartered Accountant of India. It's indeed a pleasure for me, and the way you had introduced, there was no need for the WRC, but as a customary note, you did that job. Thank you very much, Sanjay. Let us, you have discussed many things, but nowadays, Schedule 2 and Schedule 3, what are the common non-compliance into it? We will discuss on those things. No doubt, from next year onwards, the Schedule 3 is going to change. There are many other new requirements are coming. So we will not be dealing with the new requirements because we don't want to get, I don't want to get you confused, at least for this particular area. Once the season for preparation of the balance sheet is done away with, for this March 21 ending, then we'll be probably having the discussion further and some more sessions further thereafter. And we can see for the next year that what are the new changes in the Schedule 3. But today, I'll restrict myself to the commonly found non-compliances in Schedule 2 and Schedule 3. I'll share my screen to all of you. Just a minute. No one can see your screen. Click to start your screen. Oh, so okay.
सर आपका स्क्रीन शेयर है, अभी पीपीटी ऑन करिए सर आपका.
Is it okay? Can you see?
सर स्लाइड शो पे नहीं हुआ अभी तक.
नहीं, अभी मेरे को मेरा वीडियो यहाँ से कम करना पड़ेगा. वो कैसे कम कर सकते हैं? मेरा सामने वो देखना पड़ेगा ना. I think just you can use this. नहीं, fine. I think.
सर स्लाइड शो पे.
Yeah, I'm going. So I think it is visible to all of you, right?
Yes,
so,
sir.
Thank you. So let us discuss with the various commonly found non-compliances in the Schedule 2 and Schedule 3. So friends, this presentation covers the following things today. In Schedule 2, as far as Schedule 2 is concerned, what are the key concepts and what are the non-compliances observed? And in case of Schedule 3, what are the key concepts and what are the non-compliance observed in Division 2 and non-compliance observed in Division 1. Let me tell you, friends, and accept this, that this presentation is, which I am presenting before you, is made by Financial Reporting Review Board, FRRB, of Institute of Chartered Accountant of India. However, I am presenting it to all of you. What are the key concepts in the Schedule 3? Schedule 2. See, friends, Schedule 2, as we know, Schedule 2 deals with the depreciation, and depreciation is just systematic allocation of the systematic allocation of depreciable amount of the asset of over its useful life. The concept was different earlier. Now the concept is different. Schedule 2 to the Companies Act 2013 lists down the useful life of the assets which the company needs to follow for the purpose of calculation of the assets. Any change in useful life which is different than what is mentioned in Schedule 2, if you want to use the new life, then it is required to be backed by the technical evaluation and disclosed adequately in the accounting policy for the readers to understand the same in a better way. Then there is no system of depreciation like straight line method and the written down value method, which was there earlier in Schedule 6 as per 1956 Act, but now it is only based on the indicative useful life of the assets. Useful life is a period over which an asset is expected to be available for use by an entity, or the number of productions or similar unit expected to be obtained from the assets by the entity. So how much productions can be done in a year, or for how much period that particular asset will be useful. That is how the useful life is to be calculated. Companies are allowed to follow different useful life, as I told you earlier. Residual value, useful life, and residual value. If an appropriate justification is given and that justification is supported by the technical advice. No separate rate is there for any double shift or triple shift depreciations. as per the useful life, the depreciation is to be charged. If it is being used double shift, it will be double, and if it is being used triple shift, then it will be triple. So accordingly, proportionately, it will get increased. And there is no reference to the depreciation on low value assets. Earlier, अगर 5,000 रुपए से कम की एसेट है तो उसको 100% depreciate कर देते थे as per schedule 6 requirement of earlier schedule 6 and earlier requirement of 1956-8. But now 5,000 तक की एसेट हो या 2,000 की एसेट हो या 2 लाख की एसेट हो, the useful life concept is there, and according to that only you have to depreciate the asset. Now one more concept has come into the existence, and that is of component accounting and useful life of significant part of an asset to be determined separately. Component accounting is being done for the purpose of the significant part of an asset. What is component accounting? Basically, component accounting where the cost of a part of the asset is significant to total cost of the assets, and the useful life of that part is different from the useful life of the remaining asset. Useful life of that significant part shall be determined separately. It is called as the component accounting. So take an example of the aeroplane, and in the aeroplane, say suppose one engine is being replaced, which is having different useful life than the whole body of the aeroplane and all other things, then it can be the useful life of the same engine can be the different from the whole aeroplane as a whole. So it will be depreciated on a different useful life. So that's how the component accounting is to be done, and is to be the significant part of the assets can be depreciated accordingly. The determination as to whether a particular part is significant or not, this will require the careful assessment of the facts and circumstances, and the professionals, the chartered accountant and the other professionals who are doing it, they need to use their professional skepticism and knowledge and skill set into it. The component accounting is required to be done for the entire block of the assets and not for one or two. So when you are going ahead with a particular concept, then it is required to be done for the whole block of the assets. Earlier, companies need to expense replacement cost in the year of incurrence. However, under component accounting, companies will capitalize these costs as a separate component of the assets. पहले क्या होता था, जो भी ऐसा कोई भी बड़ा कंपोनेंट आया तो रिपेयर्स एंड मेंटेनेंस में या रिप्लेसमेंट कॉस्ट में करके डायरेक्टली प्रॉफिट एंड लॉस अकाउंट को हम डेबिट कर देते थे. But now it is capitalized, and since it is having the different useful life, it is depreciated over that useful life. Now the non-compliance regarding Schedule 2 to the Companies Act. Let us take the first case, that is with respect to the property, plant and equipments. With respect to the depreciation accounting policy, what is written in one of the balance sheet of the company, that depreciation on property, plant and equipment is provided on straight line method over their useful life and in the manner specified in Schedule 2 to the Companies Act 2013. However, in respect of certain plant and machineries and electrical installation, depreciation is provided as per their useful life, assessed on the basis of technical evaluation by the external valuer ranging from 20 to 40 years. Is this particular presentation is right in the accounting policy? The disclosure is right? Friends, no. You can have the different useful life for asset. But just saying and writing in the disclosure that the useful life of these assets are ranging from 20 to 40 years, whereas there are 10 assets, of which 5 assets are having the different life, maybe 20 years, 25 years, 30 years, 35 years, and 40 years. But you have said that these 5 assets are ranging from so and so. So that is not right. For each assets, whatever life is there, according to that, the disclosure is required to be made. You have to be very careful. Otherwise, to that extent, it will be a non-compliance of the Schedule 2, and accordingly, it will be a wrong thing in presentation of the financial statement. Second one we can understand is the from the accounting policy on depreciation given in the annual report of a company, it was noted that the management re-estimated the useful life of all fixed assets in so and so year, while comparing the lives estimated by the management with the lives indicated under Schedule 2 to the Companies Act. It was noted that in certain cases, the lives estimated by management are different from lives prescribed under Schedule 2 to the Companies Act. So this is how the note was made, but that is not the right way of mentioning. It is viewed over here that as per paragraph 3 of Schedule 2, company should disclose the lives used for the depreciation of those assets, which is different from the lives prescribed under Schedule 2, and it should be supported by the technical evaluation advice. So that kind of disclosure is required. You just can't write some assets are on this and some assets are on this. So, however, the company has neither given such disclosure nor the justification duly supported by the technical advice for such difference. Even the useful life of all the assets have been provided without any specific disclosure for the useful life, which is different from the useful life prescribed under the Schedule 2, which is not in line with the requirement of Schedule 2 of the Companies Act 2013. So to that extent, it is a non-compliance, and one has to take care when you are having the different useful life, and you just can't say that some assets are on the basis of the useful life prescribed in the Companies Act, and some assets are having the different useful life. It has to be disclosed completely that on what basis the different useful life have been arrived, and this particular evaluation, technical evaluation report and documents has to be there. From the note on fixed assets of company, it was noted that the assets were transferred on April 29, so and so, but the depreciation charged on such asset is reported as rupees there. Now, what Schedule 2 says is that if there is a use of the assets, even for 1 day or 2 days or 3 days, then the depreciation has to be proportionately charged in the books of accounts. So here, the asset was transferred on 29th April and no depreciation was charged. So that was the wrong presentation in the financial statement. The depreciation for 29 days should have been booked in the financial statement, should have been debited to profit and loss account. That could have been the right way of presentation. So this is the wrong presentation of in the financial statement, and to that extent, it's a non-compliance. Some of the assets of the company were depreciated based on the estimated useful life different from the useful life specified in Schedule 2. Writing like this is also not the right way. You are just writing a note in the accounting policy that some of the assets of the company were depreciated based on the estimated useful life different from the useful life specified in Schedule 2. That's the not right way. As I told you earlier also, this is the one has to make the complete disclosure the case indicates that for the purpose of charging depreciation on asset, the company has used useful life of the asset, which are different than that specified under Schedule 2, but no disclosure for the same has been made. And if it is different, then it has to be backed by the technical evaluation also. So to that extent, one has to keep in the mind a proper disclosure, which is also backed by the proper documentation, has to be done in the financial statement and in the accounting policy. So otherwise, it is a non-compliance. Thank you. Now, let's move to the key concept of Schedule 3 to the Companies Act. So what are the key concepts with respect to Schedule 3? Let us understand those key concepts. Schedule 3, read with Section 129 of the Companies Act 2013, prescribes the formats for the financial statement known as the balance sheet, statement of profit and loss, and general instructions for preparation of the same. There is also one more thing which is known as the cash flow statement. But however, the format of the cash flow statement is governed by the AS13. Format has not been defined and shown in the Schedule 3, but the format of the cash flow is governed by the Accounting Standard 3. Schedule 3 of the Companies Act replaces the revised Schedule 6 with additional requirement for preparation of the consolidated financial statement. Schedule 3, Division 2, prescribes format for Ind AS compliant financial statement. Now, if compliance with requirement of the Act, including accounting standard, requires a change in the treatment of disclosure in financial statement, then the changes as per the requirement of the Act, accounting standard shall be made and requirement of Schedule 3 shall stand modified accordingly. So, जो भी Schedule 3 में requirements दे रखी है, वो requirement तो आपको care करनी है, but उसके अलावा अगर accounting standards की कोई requirement है या एज पर एक्ट कोई दूसरी रिक्वायरमेंट आती है तो टू दैट एक्सटेंड इट विल स्टैंड मॉडिफाइड, उतना आपको और एडिशनल इसमें जो है प्रेजेंटेशन करना रहेगा. Informations relating to each item on the face of balance sheet and the statement of profit and loss to be disclosed in notes with cross references. We have prepared 8 balance sheet till now, so we know all these things. So I don't need to deliberate much on this particular point. Sorry. What happened?
क्या हुआ सर?
नहीं एक सेकंड, मेरा प्रेजेंटेशन में गड़बड़ हो गया, प्रिंसिपल में चला गया, पीछे चला गया. Key concept, consolidated financial statement. Requirement of Schedule 3 applies to consolidated financial statement too. Earlier, the consolidated financial statements were required only for the listed company. Parent subsidiary shares in the net assets and profit and loss are also required to be given. Consolidated financial statement to be audited are also required to be audited, approved, and adopted in the similar way as the standalone financial statements are being done. Now, non-compliance with respect to Division 2 of Schedule 3. So let us discuss that one. First one is with respect to the rounding off of the figures. So now the key requirement of Schedule 3, Division 2 is that the figures in the financial statement must not be disclosed in full. It is required to be rounded off. And when it is required to be rounded off, where it is written shall be rounded off. So it is must that we should round it off. And how it is to be rounded off? That less than 100 crore turnover, it is based on the turnover. If the turnover is less than 100 crore, to nearest hundreds, thousands, lakhs, or millions, and decimal thereof. And if it is 100 or more crore, then nearest lakhs, millions, crores, or decimal thereof. Or once you have decided about a unit of measurement, then that particular unit is to be used uniformly in the financial statement. You cannot change the same. Therefore, this necessary care is required to be taken by us that we consistently follow the rounding off system which we have adopted once, and it should not be changed. Now let us start with the case. It was noted from the notes to the accounts that the corporate guarantee issued to banks and financial institutions has been disclosed under the head of contingent liability. So first of all, we need to understand the nature of the guarantee, and then we have to decide that whether this guarantee can be shown in the contingent liability or not. And as per paragraph 8.2.14.1 of guidance note on division 2 of schedule 3 issued by the Institute of Chartered Accountant of India, a contingent liability in respect of guarantees arise when a company issues guarantees to another person on behalf of a third party. For example, when it undertakes to guarantee the loan given to a subsidiary or to another company, or gives a guarantee that another company will perform its contractual obligation. So this is a guarantee on behalf of third party. And there can be another guarantee where the company is giving guarantee for performing its own contractual obligations. However, where a company undertakes to perform its own obligation and for this purpose issues what is called a guarantee, it doesn't represent a contingent liability, and it is misleading to show such item as a contingent liability in the balance sheet. So when you are issuing the guarantee and that guarantee is for third party and third party fails or may fail, then those kind of guarantees need to be shown as the contingent liability. Whereas if you are issuing the guarantees for your own contractual obligation, such as for the payment of insurance premium, deferred payment to foreign suppliers, letter of credit, etc., then these counter guarantee given by you are not the contingent liabilities. Correct? So this care is required to be taken by you, and you need to understand the nature of the guarantee, and accordingly the presentation is required to be done in the financial statement. Otherwise it will be a non-compliance. The next one is, it was noted from related party disclosure that receivable from redeemable preference share pertains to an enterprise controlled by the company and it is a related party. However, under the note regarding receivable from redeemable preference share, the specified receivable has not been classified as due from the related party. So what is required to be done? In this particular case, by the FRRB, it has been viewed that such disclosure is not in line with the requirement of paragraph 8.1.10 of the guidance note, and since there is not a proper disclosure with respect to the related party transactions on the redeemable preference share, so it is required to be done accordingly, and to that extent it will be treated as a non-compliances. It was observed that the loans from related party had been appearing as line item under the note on long-term borrowings. However, the terms of repayment has not been disclosed. Whether it is a right representation in the financial statement, so I believe it is not right, and that is why it is there in the FRRB's findings. As per paragraph 6EI4 of the general instructions for preparation of balance sheet given under part 1 division 2 Ind AS schedule 3 to the Companies Act, the disclosure for term of repayment of term loans and other loans should be made. It was viewed that loan taken from related parties would be covered under the term other loans. Accordingly, repayment term should have been disclosed as per the aforesaid requirement. The repayment term has not been, so it should have been, instead of long-term borrowing, it should have been there in the other loans and not in the long-term borrowings. Next, from the financial statement of a company, it was noted that there are various defaults in the repayment of loans. Further, paragraph 8 of the annexes to the audit reports, the auditor has reported that there has been delay in timely repayment of dues to banks for ECB and to financial institutions for debentures. And in respect of working capital facilities from banks, there has been overdrawing in the accounts during the year as well as at the year end. Under remark column, the auditor has reported the status of payment of these default, according to which certain dues were unpaid and certain dues were paid before signing the date. What is the requirement basically? When there is any default with respect to the loans taken or any borrowing, which is term loan or so, then what is the requirement? When we have taken the loan, the corporate has taken the loan, each default for each loan is required to be shown separately. So that has not been done, one thing. And if the default is there, and if the default has been made good during the period ending on 31st March itself, then there is no need of showing that default. But if the default is there, continue till the date of signing or even after the date of signing, then it is required to be disclosed properly in the notes. So that care is to be taken. Here it has not been shown like that and has not been reported like that. So to that extent, this is a non-compliance. So one has to be very careful with respect to that. It was noted, another case, it was noted from the notes to accounts that the certain amount of external commercial borrowing is due in next 12 months. However, no disclosure was found for current maturities of long-term debt under the current liabilities. So it's continued to be shown in the long-term borrowings only. So that was a wrong, should have been shifted to current liabilities, which has not been shifted. That is a wrong representations. It was viewed that the requirement of paragraph 8.2.10 of guidance note has not been complied with. Specified para requires presenting current maturities of long-term debt under the other financial liability grouped under the current liability. It is recommended that the company must follow the presentation requirement of Ind AS schedule 3. So this is how the FRRB has viewed it. Now we must keep this thing in mind, and accordingly we should show if these kind of case appears in your balance sheet. Be careful, otherwise it will be a non-compliance. it was noted that the company has disclosed a line item, namely gain on fair valuation of derivative under the schedule of other income. So whether it is right, fair value, it was noted, it was viewed that the company has not disclosed gain on fair valuation of derivatives as from the instrument categorized as FVTPL, fair value through profit and loss. As per Ind AS 107 para 20A, read with paragraph 9.2 of the guidance note, the gain on fair valuation of derivatives should be explicitly disclosed as gain on the fair valuation of the derivatives at FVTPL under the subhead non-operating income. It cannot be shown as other income. See, now in the new concept, it is operating and non-operating income. So in the non-operating income, it should be shown separately, like gain on fair valuation of derivative at FVTPL. FVTPL stands for fair value through profit and loss. The company under review is engaged in the business of trading and manufacturing of certain goods, and it has its own manufacturing facility. However, in the statement of profit and loss, the cost of material consumed has not been disclosed separately. Instead, the same has been clubbed under the purchase of stock in trade and raw material and changes in the inventory of the finished goods and stock in trade. Is it right? So the company under review is engaged in the business of trading and manufacturing. So how it has to be done when you are making a balance sheet or the statement of profit and loss account for these kind of companies? What is the requirement that both the category is required to be trading activity as well as the manufacturing activity is required to be shown separately. So it has to be shown separately. Trading activities should be shown in the trading, and manufacturing activity should be shown in the manufacturing. For the purpose of manufacturing activity, opening balance of raw material, consumption of raw material, closing balance of the purchase of raw material, then closing balance of raw material, and the net will be the consumption of raw material. Like that, it will be shown as far as the raw material is concerned. And for traded goods, it will be opening balance of trading goods, sold during the purchased during the year, sold during the year, and closing stock of the trading goods. So this is how it is required to be presented, which care has to be taken by us. From the note on other equity, it was noted that there are various reserves. However, nature and purpose of these reserves has not been mentioned. So what is the requirement? When there are various reserves, then each reserve has to be disclosed separately in the other equity. Like if there is a revaluation reserve, general reserve, profit and loss, or redemption reserve, all these reserves are to be shown separately over there in the other equity. If it has not been shown, then it is not a right presentation. And there also, in all these reserves, the complete activity during the year, reconciliation of reserves during the year has to be done. Opening balance, addition, appropriation, and closing balance under the each category of reserve has to be shown. Otherwise, it is a non-compliance. It was noted from the financial statement that the significant balance of other advances has been disclosed as doubtful. So significant balance of other advances has been disclosed as doubtful, whether it is right. So in this particular case, what is viewed by the FRRB is that the nature of these advances has not been disclosed. It all depends on the nature of the advances. So nature of advances are required to be disclosed as per paragraph 6A(x)(2) of the general instructions And further, no provision has been made for such doubtful. It has been shown as doubtful, but provision has not been made. So two kinds of mistakes have taken place here. One, the nature has not been disclosed for the advance, and the other one is no provision for the doubtful debts has been made. So that care has to be taken while you are drafting or you are preparing the financial statement. It was noted from the notes to the accounts that the trade receivables have been disclosed as doubtful. So trade receivables has been disclosed as doubtful. Again, trade receivable has to be disclosed on the aggregate value. It is a financial assets. Credit loss is required to be calculated as per Ind AS 109 expected credit loss, and then it is required to be presented. So you have to take care because it is a financial assets. The company is required to recognize a loss allowance or you can say impairment allowance for the expected credit loss on the financial asset, which includes the trade receivable also. So you have to show the aggregate value, impairment amount, and the net value. This is how the trade receivables are required to be shown. So be careful while you are disclosing the same. It was noted from the notes to the accounts that the financial assets in the form of the investment in share of the companies have been wrongly disclosed under the inventory. So it's a completely wrong concept. How an investment in shares can be shown in the inventory. And when you have shown it as the inventory, the complete picture is a wrong picture. It's not giving the true picture of the financial statement for the purpose of users of the financial statement, because the investment is investment and inventory is for the resale. Investment is always for a long time period. So it is completely a wrong presentations in the financial statement, and you have to be very careful about this. Otherwise, it will be a non-compliances. It was noted that the investment in subsidiaries, associate, and joint ventures have been disclosed separately from other than the financial statement. So what is the requirement? That para 8.1.8.4 of the guidance note deals about the various kind of investment, and when it is with the subsidiary and the relevant Ind AS applicability of Ind AS 32, Ind AS 107, Ind AS 109 for the subsidiary, associate, and joint venture. Such investment still meets the definition of the financial instrument and may be presented as the separate line item on the face of the company's standalone balance sheet. In any case, the disclosure requirement of Ind AS 107 would not apply to these kind of investment. And it is accordingly viewed in this particular case over here that investment in subsidiaries, associate, and joint venture should be considered as a part of financial asset and shown under the head of financial asset as a separate line item in line with the requirement of paragraph 8.1.8.4 of the guidance note. So it is required to be shown as a separate line item, an investment in subsidiary, investment in associate, and investment in joint venture. That care is required to be taken. It was noted that other bank balances have been disclosed under the head of balance with bank. Further, it was also noted that the amount is material. When the amount is material, the nature of the bank balance is required to be disclosed. And when the nature is not been disclosed, then it is a it is not a proper presentation of the facts in the financial statement. So it is viewed that since the balance of bank is material, therefore the nature should be disclosed. To that extent, it's a non-compliance. Be careful when these kind of things happens. with you when you are preparing the balance sheets and financial statement, then accordingly see that the nature is being disclosed when the amount is material, when you are showing this the bank balances. It was noted from the financial statement that the fixed deposits with the banks having maturity period of more than 12 months have been classified as investment. See, एक हैबिट थी हम लोगों की पहले जब बैलेंस शीट बनाते थे 5 साल 10 साल 15 साल की जो फिक्स डिपॉजिट होती थी 7 साल की so what we were having one kind of opinion that यार ये तो इन्वेस्टमेंट है हमारा, so इन्वेस्टमेंट में शो, and that mentality continued, but that is not the right things as per the schedule 3 of Companies Act 2013. You cannot show this as an investment. Bank deposit with more than 12-month maturity shall be disclosed under the head other financial assets and not as the investment. So please take care and show this under the other financial assets. Otherwise, it will be treated as the non-compliances. Earlier, when we were making the financial statement as per Schedule 6 and of 1956 Act, yes, many times it has been shown, but this is not the case now. From the note on account, not on investment, it was noted that the investment were classified as unquoted investment. The aggregate investment amount and the aggregate impairment value not disclosed. So the investment for unquoted item, unquoted investment, when you are required to disclose quoted investment, the valuation is straight away coming from the stock action. When it is unquoted investment, and if any impairment is done or any diminution in the value has taken place, then you have to show it separately. So the first you have to show the aggregate value of the investment and then the impairment in the investment and the net value thereafter. This is how it should have been shown. If you are not showing like this, then that is a wrong way of disclosing the fact, and that will be a non-compliance. Under the note on loans as given in the financial statement of the company, the line items appeared as under loan and advances to related party, loan and advances to employee, forward income, receivable, other advances constituting the significant amount, and interest accrued on FDR. So is it a right way of disclosing of the loans and advances? Loans and advances जो अभी आपको as per Schedule 3 Companies Act 2013 disclose करना है, वहां पर nature of loans has to be disclosed. That is the mandatory requirement. So it has not been disclosed. Whether secured, unsecured, doubtful, all these things have to be disclosed over there. So this is a complete wrong picture of the disclosure. It should not have been done like this. So be careful and see the general instructions which are there for the preparation of the financial statement, and accordingly also go through the guidance note of the institute and present in the financial statement. It was noted from the financial statement that no disclosure has been made about the CSR activities. So again, non-compliance, you have to disclose. And what is the requirement of disclosure? The disclosure is required under paragraph 7J of the general instructions, and also just go through the 11.5 paragraph of guidance note which has been issued by the ICAI with respect to division 2 of the Ind AS Schedule 3, and there the how it is required to be disclosed is mentioned, and neither the amount spent is required to be disclosed, whether it has been spent, and if it has not been spent, then why it has not been spent, the reason has to be there. But the amount required to be spent, that is required to be given over here. And if it has not been, then to what extent it has not been spent, this is also required to be given. However, the changes are taking place next year onwards, so the other mandatory requirements are coming. So next year we will deal this particular subject or case in a different way. Sorry. It was noted from the notes to the accounts that the deduction of interest on prematurity of FDR has been included in the finance cost. FDR, interest on prematurity of FDR, can it be included in the finance cost? No, it cannot be. It is not a finance cost. Basically, finance cost is a cost which you are giving on some loan or so. That is treated as the cost, but this is not a cost. This is an earning, and when this is an earning, what kind of earning it is, that has to be seen by you. And when you make the fixed deposit, when you have the surplus fund, which is your working capital, and you deposit for sometimes in the banks. So these are the working capital surplus fund deposited into the bank. So it is a this income is a other operating income, which is ancillary revenue generating activity. So therefore it will be shown as the other operating income, and not as the it will not be reduced from the financial cost. So that care has to be taken, otherwise it will be a wrong representations from our side. Now next is non-compliance object pertaining to division 1 of schedule 3. And what are these? Let us deal with first one with respect to paragraph 6 A, D and E, and where it is relating to the share capital disclosure requirement given in one of the annual report of some of the companies, and how it has been done. The non-disclosure of the rights, preference and restrictions attached to each class of share. So company has not disclosed the right, preference and restrictions with respect to each class of share. This should be disclosed even if the company has only one class of share. If there are 2-3 class of shares, for each class of share, and if there are only one class, then also to that one class, what are the rights, what are the preferences, and what are the restrictions, all those things are required to be disclosed. Otherwise it is a non-compliance. Then next is a reconciliation of each class of share outstanding at the beginning and at the end of the period was not disclosed. This is also mandatory. See, wherever 1 class, 2 class or 3 class of shares are there, and if there are any pluses and minuses into it, if it has been issued or extinguished, then all those kind of pluses and minuses are required to be disclosed over here. It is mandatory, otherwise it is a non-disclosure. So non-disclosure of rights, preference and restrictions attached to each class of shares, as well as reconciliation of shares of outstanding, are not in line with the requirement of paragraph 6A of general instruction, and therefore it is treated as the non-compliances. Again, with respect to the share capital only, under the disclosure regarding shareholder holding more than 5% share, it is stated that a company is holding more than 51% share. See, 5% शेयर्स जिसके भी पास ज्यादा 5% से ऊपर है तो उसका डिस्क्लोजर देना जरूरी, उसका नाम देना है, कितने परसेंटेज शेयर है, कितनी क्वांटिटी है, दैट इज रिक्वायर्ड टू बी गिवन एंड व्हाट इज द वैल्यू. बट अगर किसी कंपनी के पास में 51% शेयर है तो वहां पर आपको उस कंपनी उस डिस्क्लोजर के साथ साथ लिखना पड़ेगा कि शेयर्स हेल्ड बाय द होल्डिंग कंपनी. If it is 51%, then it is a holding company. That company has become the holding company. So you have to show that company is a holding company, and that disclosure is required to be made, otherwise it is a non-compliance. Unpaid calls shown as receivable without adequate disclosure. So how unpaid calls is required to be shown? It is viewed that the gross amount of share capital should be disclosed first, and then calls unpaid should be reflected as deduction from that. If it has not been done and straight away shown as unpaid calls receivable, then it is a wrong disclosure. So gross less unpaid calls, that is how it is required to be shown. Otherwise, it is a non-compliances. Share application money pending for allotment reflected as part of the share capital. It cannot be done like that. Share application money pending allotment cannot be shown as the share capital money. How it is to be disclosed as per the requirement of Schedule 3 of the Companies Act 2013, that this is required to be disclosed as separate line item between shareholders fund and non-current liabilities. In between these two, this line has to come as a separate line item, share application money pending allotment. This is how it is required to be shown. Then again, 6B1 deals with reserve and surplus disclosure. In some of the annual reports, some mistakes have been found, and some disclosures have been found in this particular way. It is not right. For each of the specified head of reserve and surplus, only the final amount at the end of the period were reflected. So this is wrong. General reserve, so much amount. Redemption reserve, so much amount. Revaluation reserve, so much amount. The calculation is done somewhere else and you have given the final. आपने accounts में से उठाया और final figure लाके यहाँ पर डाल दिया. That is not the right way of application. General reserve आप दिखा रहे हैं तो general reserve opening balance, aid during the year, appropriation and the closing balance. In the same way, profit and loss account, if it is there, opening balance, addition during the year, appropriation during the year and the closing balance. Likewise for revaluation reserve also and for redemption reserve also. So this is how the presentation is required to be done. Otherwise, it is a wrong presentation and it's a non-compliance. Appropriation from the profit and loss for the year reflected on the face of the statement of profit and loss. No, it cannot be. Earlier, as per Schedule 6 requirement of 1956 Act, we were showing the appropriation in the profit and loss statement, but now it is not in the profit and loss statement. The appropriation is required to be shown in the reserve and surplus. That this much amount as the this much amount has been appropriated. The profit and loss goes over there, and from the profit and loss, if dividend distribution is there, then use of that will be reduced and it will be shown over there. So appropriation is required to be shown in the appropriation is required to be shown in the reserve and surplus. Debit balance of statement of profit and loss was reflected on the asset side of the balance sheet. So debit balance, again, negative balance or debit balance. So debit balance, this was also an old system. Debit balance of statement of profit and loss we were showing in the asset side of the balance sheet. That was the requirement earlier of Schedule 6, 1956 Act. But now in 2013 Act, Schedule 3 requirement, negative balance of the profit and loss account will be shown in the reserve and surplus. Even if it is negative, it has to be deducted over there, but it will be shown there only, and it will not be shown on the asset side of the balance sheet. Paragraph 6C and G with respect to the long-term borrowing and short-term borrowing. And here, secured borrowing includes loan availed by creating charge on the property of a director and his personal security. You can have the borrowing or loan and you can the directors can give their personal property also as a security. But what is important here is the disclosure, complete disclosure about that security. The details is required to be given under that head. This loan or this borrowing is secured by the personal assets, so and so assets of Mr. So and so. That disclosure is required to be made over there, and if that has not been made, then it is wrong. So here, to that extent, it is a non-compliance. Current maturities of long-term borrowings were reflected as short-term borrowing. Current maturities of, see, this is again a wrong thing. It is required to be shown as the other current liability, which has not been shown. So it's a non-compliance. But from next year onwards, where the changes in the Schedule 3 has come, it will be shown as the short-term borrowing only and not the other current liability. But for the balance sheet which you are making for March 21, be careful if this kind of situation is coming where some current maturities of long-term borrowings are there, long-term loans are there, and during the year, if any installment is due, then that will be treated as the other current liabilities and not as the short-term borrowings. Bonds, debentures were disclosed with the type of bonds, debentures, and rate of interest only. This is again a non-compliance. The complete details are required to be disclosed with respect to the bonds, debentures. You are just writing 6% so and so bonds or 9% so and so debenture. That is not right. The complete details about the redemption and quantity, etc. All the details are required to be given. Okay, what are the terms of the issue of these bonds and debentures? So and so debenture redeemable on so and so, something like the whatever is the conditions that is to be disclosed over there. That is important. Paragraph 6C(f) with respect to the again long-term borrowings and short-term borrowings. A convertible debt instrument maturing after 2 years where the conversion options for the issuance of equity is exercisable by the holder at any time classified as short-term borrowing. How? It cannot be. It is wrong. Though there are no terms and there is a term that you can exercise and you can get it converted into the equity in after 6 months at any point of time, but the document is for 2 years, then in that case, nobody has, since the exercise, it cannot be shown as the short-term borrowing and it has to be shown as the long-term borrowing only. Notes on the trade papers. In the trade papers, it includes the dues payable in respect of the statutory obligations like PF, due dates, and dues towards the purchase of fixed assets and other contractual obligations. This is again wrong. Trade payables are what? Trade payables are the amount payable against goods received, goods supplied to us, and services received by us. So if there is any payable against that, then that is a trade payable. Otherwise, the other payables for any other things, if there is any amount due, that is the other payables and not the trade payables. So only the trade payables are required to be shown, and if the other kind of amounts are due, then it is required to be shown as other current or non-current liabilities. Then provisions, not on provisions. It was observed that the valuation of gratuity and leave encashment done by the actuary provided current and non-current portion both, but gratuity was classified as long-term and the leave encashment was classified as short-term. So it is again a completely wrong presentations in the financial statement when the actuary has given you the bifurcation of current and non-current portion for both gratuity as well as leave encashment. Then to that extent, you have to disclose in the financial statement for gratuity also and for leave encashment also, current and non-current portion both, as current long-term provisions and short-term provisions. That will be the right way of disclosing. Otherwise, the way it has been disclosed is completely a wrong disclosure and it's a non-compliance. With respect to fixed assets, a company having tangible and intangible asset didn't categorize the same accordingly. So tangible and intangible assets has to be categorized in a particular way. Tangible should also include capital work in progress, and intangible should also include the intangible asset under development. Both the things are to be taken care of, intangible and tangible. And if there is any capital work in progress, then capital work in progress for tangible asset or intangible asset under development in case of the intangible assets. This is how it is required to be disclosed. Advance given for capital asset where the work is under progress was included in capital work in progress. So if you had given the advance, how it is to be shown? Say it cannot be included in the capital work in progress because you had only given the advance, and if you do not know that in how much time, if it is taking time, the schedule of delivery of assets is 12 months, 6 months, 30 months, 15 months. According to there, normally if it is for more time advance you had given, then it is required to be shown as long term under the long term loans, because you have given advance for a long term period, and it has to be shown over there and not in the capital work in progress. Capital work in it will come and get converted into capital work in progress when against that advance the assets have come and you have started implementing it, and it has not been put into the use. Then those kind of things will come in the capital work in progress, and not these kind of advance will come under the capital work in progress. Tangible assets included owned asset as well as lease assets. Here tangible assets, if it includes both kind of asset, then no problem, let it include, but the disclosure with respect to the leasehold and freehold property has to be given separately under the tangible head. Paragraph 6K of the general instructions for preparation of the balance sheet of part 1 schedule 3 of the Companies Act 2013. Friends, this is with respect to the investment, and in case of the investment in associate and joint venture was not disclosed, though such disclosure was made in the related party. So what is the requirement here? Investment in associate and joint venture was not was made as a related party, but it has not been made. So to the extent the investment has been made into these, that investment is required to be disclosed, that this much investment is there in the joint venture and this much is there in the associate. To that extent, the extent of the investment is required to be disclosed. Investment in partnership firm included investment in LLP. So it is again not the right things. LLPs are the corporate entity, and the partnership firms are set up under the Partnership Act, whereas the LLPs are set up under the incorporated under the LLP Act, and it is a corporate entity. So investment in the partnership firm is different from investment in the LLP. It cannot be shown like that. The notes with respect to the inventory, trading stock of the company which was into manufacturing and trading activity was included in finished goods stock. I told you earlier also that when you are showing the trading stock or manufacturing finished goods stock, and if there are two kind of activity, both are required to be shown separately. So trading stock is there, then the trading activity has to be disclosed separately. The manufacturing activity is there, manufacturing activity are also required to be disclosed separately, and accordingly the stock is to be shown in the financial statement. Goods in transit including towards raw material stock in trade and stores and spares was disclosed together as such. एक ही लाइन में आपने दिखा दिया goods in transit for raw material stock in trade and stores and spares, that is a wrong representations. Goods in transit for each category is to be shown separately, and when it is manufacturing and trading both, then the disclosure will go into that particular way where you are showing the disclosure for the traded items and for the manufactured items. There differently you have to show this goods in transit also. Not on trade receivable. Trade receivable outstanding for more than 6 months were considered from the date of invoice, whether it is right. So it has to be considered from the due date of the invoice and not from the date of invoice. Date of invoice and due date of invoice have to be checked, because in majority of the cases, due date for payment is different than the date of invoice. Trade receivables included receivables due from sale of fixed assets and investment. As I told you, in the case of trade payables, the trade receivables are what? That the receivable which are against the supply of goods by us and supply of services by us to the vendors. So whatever receivables are there, those will be under the trade receivable. And if there is any other receivable which is not from these kind of activities and which are from sale of fixed assets or investment, then these are the other receivable. So it is required to be shown as the other receivable and not as the trade receivable. Then notes on cash and cash equivalent. Fixed deposits having maturity beyond 12 months were disclosed under this head. So whether it can be shown 12 month and beyond maturity. So 12 month and beyond maturity is not a cash item. It has to be shown as other non-current asset and not as the cash and cash equivalent. Balance in unpaid dividend account was included in balance with banks under cash and cash equivalent. This is again a wrong representation. Any earmarked balance account is there, that has to be shown separately. So this is a earmarked fund, earmarked amount which has been deposited into unpaid dividend account. It is required to be shown separately, and it cannot be clubbed with the bank balances which are shown under the cash and cash equivalent. So it's a non-compliance to that extent. So we need to be careful about this also. Not on laws.
Durgesh sir, next 5 can we wind up, sir?
Yes. We will wind up. Don't worry. Next 2 minutes we will wind up.
Okay, sir. Thank you.
Not on loans and advances given in the annual report of some companies, it was observed that provisions for bad and doubtful advances were disclosed in aggregate for all types of loans and advances. So that is again wrong. The nature of each nature of each loans and advances is required to be shown. If nature is not shown, then it is wrong. And for according to the each and advances nature, the separate disclosure is required to be done. It cannot be shown in aggregate for the different category. The different it has to be shown separately. Loans and advances to related parties were not disclosed separately under the head loans and advances. So under the head loans and advances, if any loans has been given to related party, it has to be shown separately. It is a requirement as per the S18 also, and as per the requirement of 6R also. So you have to be careful, and accordingly it is required to be presented. And the more stringent disclosures have come with respect to the related party in the next year onwards, when the new schedule 3 will become applicable. So we need to be very careful about that. So with this, I end my presentation. When we are I normally close my presentation with this particular quote. When we are no longer able to change the situation, we are challenged to change ourselves. Victor E. Frank has told this, and I am a firm believer of this. We are not in a position to change the situation like COVID pandemic, and we have changed ourselves and started learning by the virtual mode. So this is how we have done here, and I'm sure that webcam can be shown. I do not know how it is to be shown. Fine. Hidden your webcam. So when the law have changed, like Companies Act have changed, Schedule 3 have changed, or some other law, CARO is going to change. So what exactly you need to do? You need to understand all those things. You cannot change them. You have to change yourself. You have to understand them. You have to see that your clients are being educated. They have been well informed about this, and the compliance part has been done properly. So that is what is important for all of us, and we have to be very careful with respect to this. And I'm sure, friends, when we will be doing this and we will be doing the justice and preparing the balance sheet, financial statement, and doing the audits, complete ethics and quality, I'm sure we'll be doing wonderful job, and we'll be doing justification, all kind of justification, and it will help all of us. And we will always be keeping the flag of our profession high. If we imbibe these two things, ethics and the quality, in our audit and assurance practices, as well as when we are preparing for any financial statement, we take care of these things, the quality and ethics, that is going to make a lot of difference. So thank you very much for giving me a patient listening, and good evening to one and all once again. Thank you. Over to Sanjay. You can hear me?
Vikas sir?
Yes, sir. Yes, sir. I'm there. Only thing is
so,
the video is blurred, but otherwise I'm there.
From my side, it is over. Thanks to all of you.
Thank you very much, Durgesh sir, for your guidance to region, and it's really great session. Now we have with us CA Vikas Jain, and I request him to propose a well-deserved vote of thanks. Over to you, Vikas.
Thank you,
Chairman
Chairman
sir
sir.
is there. Yeah, great to hear your voice, Chairman sir. Thank you.
Thank you, Durgesh sir, for the wonderful deliberation. The topic has been so well explained that for sure our members will be much more careful while discharging their duties, and it is the need of the hour, because ultimately, as you rightly said, the vision that we need to keep the flag of our institute flying high, and for this there cannot be any scope for the error in the audits that we do. So thank you very much, sir, for the wonderful deliberations. On behalf of WIRC and all the participants, I extend a hearty vote of thanks to you, sir. Thanks a lot, and hope to see you, hear you on more opportunities, sir. Thank you.
Thank you. Thanks a lot.